Good morning, everyone. A very good morning to all of you. Um, Today's obviously it's the first class of the new syllabus, right? The FAR 2024 syllabus. So I believe everybody here is uh, uh, is doing FAR for the first time, right? If any of you is doing FAR, like who have done FAR already in the old syllabus and you're attending again, that's also fine. But I believe most of you are new enrollees and you are doing FAR for the first time. Uh, so I'll keep that in mind. That you are you are first time participants of FAR. So I'll keep that in mind while we are going through the syllabus. So in case you are someone who has already done FAR and you are doing it again, then you might basically you have to have patience, and because the pace of the class will be keeping those students in mind who are doing it for the first time, right? So you have to keep patience, and there would be a lot of things that you already know, so probably you are here to just revise, which is perfectly fine, but keep that in mind. I just want to start by saying that the new syllabus, which we have already covered in the webinar, that the new syllabus is shorter than the old one, and it is also apparently it is easier than the old one. Number of modules are also less, number of chapters are less, and the less complex topics are here in FAR. The more complex topics have gone to BAR, which is part of the discipline section. And so the number of hours have also been cut short. Earlier, FAR would take about 100 to 110 hours to complete. Now we have decided that we have figured that it must get completed in about 60 to 70 hours, right? So the number of hours have also gone down, and the tentative date of completion is December 23rd. Of course, there would be some holidays in between, like probably Diwali. I can only think of Diwali right now as the major holiday that's coming up while our FAR session would be going on. So maybe that weekend, we'll have to we'll see how we can adjust for that, right? Can we continue the class during that weekend? Can we have the class during that weekend, or we cancel that class and do it some other day? We'll internally discuss that and let you know. But just in case the entire weekend, both the classes of that weekend get cancelled, then it may just get pushed by another week. So instead of December 23rd, it might get over on December 30th. So that's just to give you an idea, and you can plan accordingly, when you want to take the exam. Going by past experience, if you are up to date with the classes, if you're attending the classes, here physically, and then you're utilizing the entire week to revise what has been covered during the weekend, right? Normally, what I will do is the topics that we cover this weekend, we will do the MCQs of those topics in the following weekend, right? So I'll give you that whole week to revise those topics, so that the following weekend when we do MCQs, you are able to participate, you're able to answer those questions. So this is the pattern that we are going to follow. I'll cover topics today and tomorrow. We'll do MCQs of those topics in the following weekend and cover new topics in the following weekend. And then, the MCQs of those topics will be covered in the following weekend, and so on. So this is how we are going to do it. So if you are up to date with the classes, if you're regularly attending, you are revising during the week, you're able to participate and answer questions in the following week, that means, you're in the right track. So if you can do this for the entire syllabus, till December 23rd or December 30th, as the case may be, then I would say you need maybe maximum a month's time to revise the whole thing one more time or two more times, and then you can sit for the exam. But of course, this 1 month that I'm saying should also include certain days off from office when you are able to dedicate fully for the revision, right? See, there are 6 chapters now in FAR. So first time when you do, after the course is over with me here, right? After December 23rd, I'm saying, when you revise, and if you have taken the days off, right? Right now, I'm keeping that in mind. If you have taken the days off, then it should take you 2 days per chapter to revise for the first time, maximum. Okay. So that means 12 days, you should be able to revise the entire syllabus. And that means going through the book again, right? Word by word, line by line, each and everything, going through the entire module, entire chapter again, doing all the MCQs again, doing all the simulations again. And not just that, after doing the MCQs and simulations, going back to the chapter and reading it one more time. Okay, so all this should be done in 2 days. I'm talking about for each chapter. So chapter 1 has just 4 modules, which we are going to cover this weekend. Those 4 modules you should be able to finish off in 2 days time, reading MCQs, TBS, going back and reading it again. This whole thing in 2 days. So this is chapter 1. Similarly, you do for chapter 2. Similarly, you do for chapter 3, and so on. So there are 6 chapters, 12 days. Your first round of revision should be over like this. And in that, you should be getting a minimum of 55 to 65 in the MCQs and simulations, right? So this is what normally students get when they attempt the MCQs for the first time. Of course, during these classes, I will do some MCQs with you, but those are just to give you an idea of how MCQs look like, how to approach them, and so on, right? Those are not your, I mean, I'm not counting them as your preparation for the exam. That is just to get a hang of how the syllabus is, how the MCQs are, how to approach them, right? So that's just to get a hang of it. Your real revision will start after the course gets over here. 12 days to finish off the syllabus once. Then next 6 days, 1 day per chapter this time, because obviously you have gone through it thoroughly. It should take you just 1 day to revise 1 chapter. So another 6 days, another round of revision. 18 days, you have done two revisions. And then you can, schedule your book your date. And of course, before you sit for the exam, you will go through it one more time. And this time you may not go through the entire syllabus. You may go through only the difficult portions which you feel are difficult for you. And you may go through only the flagged MCQs. So there is this feature in the software that you can flag the MCQs that you think are difficult, right? So you can flag those while you are doing during your first revision and second revision. And then before the exam, you can just go through the flagged MCQs, the flagged simulations, and maybe certain portions of the book which you think are difficult. The memorization part, maybe you want to go through the mnemonics. Maybe you just want to go through the passkeys, which are there in every module, right? So just very selective things you will do just before the exam, right? And I think the same sort of pattern you will follow for the other subjects as well. But right now, I'm just keeping far in mind. So this is, this would be my plan if I were in your place. 12 days for 1 round of revision, another 6 days, another round of revision. If you think, okay, so by the way, first round, as I said, you should get 55 to 65 in the MCQs and simulations. Second round, that number should jump to 75 to 85, right? And if it has not reached that number, that means you're not ready. You need another round of revision, whether it's a 12-day revision or a 6-day revision. That depends on how much you're scoring after these first 2 rounds, right? But the idea is that you must cross 85. So before the exam, if you do the flagged questions, or if you do all the questions, again, third time, you should cross 85 to 95. Right? The idea is that you should at least cross 85 before you sit for the real exam. You should cross 85 at home, right? So for some students, if their basics are extremely strong, then they may reach 85 in just 2 rounds. Sometimes even in 1 round, some students reach 85 plus. They start scoring 80, 85 plus just in the first round itself because their basics were extremely strong. If your basics are not so strong, or there's a huge gap between your last qualification and this time, if there's a 6-year, 7-year, 10-year gap, then obviously you have forgotten things. So basically what I'm trying to say is that some people take one round to reach 80-85, some people take 3 rounds to reach 80-85, some people take 4 rounds to reach 80-85. It's, to each his own. The idea is you must cross 85 plus at home before you sit for the real exam. This is of course my personal suggestion. This is not any not Becker's suggestion. This is my personal suggestion from my own experience and experience of so many other students who have sat for the exam, that you must cross 85-90 at home, then you will comfortably clear the exam on that day, because you need 75. So you still have a cushion, right? Even if it's not your luckiest day, you will still clear the exam because you are sitting at 90 plus, right? So you are pretty comfortable. So you have to make sure that you reach that level of confidence that yes, even on a bad day, you will still clear the exam. Clearing should not be an issue. Yes, getting 90 plus, getting 95 plus, getting the Elijah Watsels award, those things should be on your mind. Clearing should not even be on your mind. Clearing should be given that yes, I will definitely clear. Even on a bad day, I will clear the exam. That should be your confidence level by the end of it, right? And that will be my endeavor also, to help you reach there. And to do that, I'm going to take you through the book line by line, right? And trust me, it might feel a little boring initially, and even later you might feel that we can do this reading ourselves. Why are you reading it with us? But trust me, when you start revising and when you start doing the questions, you will realize why I did this. Okay, going through each and every line in the book, together will help you at the time of revision. So we'll do that. I'll take you through each and every line of the book. I'll of course keep explaining those lines. I'll keep explaining the concepts. And of course, we'll do MCQs and simulations, but obviously not all of them, just a few, just so that you know how they look like, how to approach them, right? And what level of detail they go into. So therefore, when you start revising, you know that I have to get into that level of detail to be able to answer the questions. Okay, so with that, let's get started. Very quickly, I just want to know how many chartered accountants are there in this group. Can you quickly write in the chat box, yes, maybe. Are you a chartered accountant? Just write yes if you are in the chat box, and I'll quickly count the numbers. Okay, so I can see 1, 2, 3, 4, 5, 6, 7. Okay, so that's a pretty good number. Right now we have about 40, we have 48 people, and roughly 20 are chartered accountants. Okay, so that's a pretty good number. Okay, so now here is a word of caution. I mean, of course, congratulations for becoming a chartered accountant. It's the one of the toughest exams in the world, right? Of course, it is the highest accounting credential in the country. So good job on that, I would say. Great job. It's not easy to become a chartered accountant, right? But here, for the CPA exam, a word of caution. You have to unlearn to learn. So what I mean by that is, forget your Indian GAAP knowledge, forget your Indian tax knowledge, while you are doing CPA, and learn afresh, become a student again, right? Become a student again and learn afresh. Okay, keep your the Indian GAAP knowledge, Indian tax knowledge aside for the time being while you are taking the CPA exam. Once you become a CPA, you have your entire life ahead of you to do comparisons, that okay, in India we do this, in US they do that, in India we treat this item like this, but they treat this item like that. Don't get into a comparison mode right now while you're studying for the CPA exam. You can do the comparisons later. Once you become a CPA, then you will be a CA CPA, right? You can do your comparisons at that time. You have your entire life to do that. Nobody is going to stop you. Right now, if you get into a comparison mode, it's going to be very harmful. We have had instances where students have come out of the examination hall and then they have realized that, I take the wrong answer because that was the right answer as per Indian GAAP, but it was the wrong answer as per US GAAP. You know what I mean? So once you start comparing, then obviously you are refreshing your memory of Indian GAAP and you are studying US GAAP on this side by side. And in the pressure of the exam, right? In the exam hall, you are under pressure. Clock is ticking, time is running out. You have to answer, move forward. So obviously there is pressure on your. So at that time, what happens is, it may happen. I'm saying not necessarily, but it may happen. It has happened with some of the students, that in that pressure, when they look at the answer choices, their mind says, yeah, this is the right answer because I've seen this somewhere. I've seen this line written somewhere, or I've done this concept. So this is the right answer. In that pressure, they click that, move forward. But after, once they have come out of the center and they are thinking with a cool mind that, okay, what were the questions, what did I answer, then they realize, oh, I answered it wrong. That was the right answer as per Indian GAAP or as per the Indian tax laws, not as per the US GAAP or US tax laws. So please don't get into a comparison mode. So I would say, just unlearn, just keep that aside, your knowledge of CA, keep that aside and start afresh. Now you might say that, or rather, let me say this, that of course, your knowledge of CA will definitely help you here in understanding the concepts faster, understanding them better, right? So in the back of your mind, obviously, if you are a CA, obviously you have that knowledge in you, right? All I'm saying is, of course, that knowledge will be handy here. All I'm saying is that the rules don't start comparing. Okay, the basic knowledge will obviously help you. Okay, so let me give this, maybe an example to better explain this point, and this will help both CAs and non-CAs attending here to understand this point, that if you know driving, right, and now you are moving to US, where there's a the opposite side, right? It's left-hand drive. So if you already know driving, then that knowledge of how to drive a car will help you, but you'll have to learn the rules again, the new rules, right? Because it's on the opposite side, right? So here, when we take a left, most of the times there is no signal. We just take a left is free, but for right we have to stop. For going straight we have to stop, for right we have to stop, for left we don't stop normally, right? We just take the left, it's free. But in the US it's the opposite, right? For taking a right turn, it's free, but for going straight and going left, you have to stop. So similarly here, when we cross the road, right, think about it. When we cross the road, we look to the left if any car is coming, right? Then we reach till the middle, then we look at right if any car is coming from that side, and then we cross the other half of the street, right? So we first look right, go to the middle, then look left, then cross the other half. There it is the opposite. You have to look left first to see if any car is coming, right? So what I'm trying to say is that, let's say if you know driving, it is definitely going to help you. You are going to learn it faster maybe, right? But you have to learn those new rules. Forget the old rules, because if you remember the old rules and the new rules, trust me, in driving, I'm saying, it can it can be fatal. I mean, you can meet with an accident, because suddenly your mind gets, because that's called rewiring of the brain. If your brain has not got rewired to this new system of driving, and it still has the old system of driving in your mind, sometimes you may take a wrong turn and a car is coming at a high speed from the opposite side. You know what I mean, right? So you have to completely rewire your brain to drive a car in the US. That time you have to completely forget how you used to drive in India, right? Of course, the basic driving skills will be handy. You know how to apply a brake, when to accelerate. The basic knowledge will be helpful, but new rules have to be learned. And for people who don't know driving at all, right, and are learning, and have moved to the US, so they are doing both the things. They are learning to drive also, and they are learning the rules also. But for them, learning the rules will be easier because they don't have a baggage. They don't have another set of rules in their mind. They are learning the driving for the first time. They're learning the rules for the first time. So both people will have some advantages. People who know driving will have some advantage, And people who don't know driving will have another kind of advantage, that at least they don't have a baggage. They are learning for the first time. So whatever they are learning, only that will be there in their mind when they drive. Right? So there is no chance of getting confused or getting mixed up. You know what I mean? I hope it's clear now. So same rule applies over here. If you are a CA, forget the old rules, learn the new ones, right? Otherwise, there's this scope of confusion and error. And if you're not a CA, that's also a good thing. Then you're learning these rules for the first time. There's no scope of confusion. Okay, so I think it's amply clear now. Yeah, so I think with that in mind, let's get started, right? All the best to all of you. So I'm sharing the screen here. Can you see the screen? Can everybody see the screen?
It's visible, sir.
Yes, okay. So this is FAR 1. The name of this chapter is Financial Reporting. And there are only 4 modules: balance sheet, income statement, comprehensive income, EPS, earning per share. Then there are certain reporting topics, right? Then stockholders equity, part 1, part 2. So let me say this, that since this is the first chapter, it's only introducing you to certain topics. There would be certain terms that we will come across in this chapter, but those terms have actually been explained or dealt with in detail in a later chapter. So right now, we will not go into that level of detail because it is already covered in another chapter, in detail when we reach there. So we'll cover it that time. Right now, there is only a reference over here. It's like, again, let me give you another example here. It's like, when for the first time, we learn letters when we are primary kids, we learn letters. Our teacher tells us, A for apple, right? A for apple. Now, all you need to know is that A is, apple starts with A. That's all you need to know. You don't need to know what is an apple, how many colors it comes in, what is the size, how does it look like, how does it taste, where it is found, right? Where, all those details will be covered in a later chapter. If we get into that level of detail now, then we will not be able to move forward to B is boy, right? Or C is cat. Right now, the idea is we are just learning certain terms, right? We will get into details later. Okay, so just bear with me. Whatever level of detail needs to be covered, I will of course keep covering, but whatever has been covered later, we'll cover it at that time. So we'll cover these topics, right? Hopefully, today itself, a lot of it will be covered. If not, some of it will be covered tomorrow. So balance sheet. First thing is, in the US, the balance sheet is like opposite of what we do. What you are used to. Here, if you see, the assets are on the left and the liabilities and stockholders' equities on the right. So just like in driving, they drive on the opposite side. Here also it's the opposite. Now, well, yes, initially it sounds very weird, right? Why are assets on the left? Why are liabilities on the right? Why is it opposite? But if you think of it, right, logically, if I explain the logic, then you might start feeling that, oh, that means we do the wrong thing, right? We, as in India, we write liabilities on the left and assets on the right? Now, once I explain this logic here, you might feel that, okay, we do the wrong thing, right? So your entire perception will change. See here, right now it seems very strange. Assets are on the left, liabilities on the right. But if you think about it, assets have a natural debit balance, right? Assets have a natural debit balance and liabilities have a natural credit balance. Stockholders' equity also has a natural credit balance, right? If you remember the rules of debit and credit, right? So assets have a natural debit balance. And if you think of a T account, the debit is always on the left, isn't it? Debit is always on the left. Assets have a natural debit balance. So assets are written on the left. And liabilities and stockholders' equity have a natural credit balance. And in a T account, credit is always on the right. So liabilities and stockholders' equity are written on the right. So it's very easy. It's aligned to the T account system. In the T account, debits are on the left, credits are on the right. Your assets are on the left, liabilities on the right. Makes perfect sense, right? So this is how they write their balance sheet. And guys, just give me one moment, please. I'll be right back. Just give me one moment. Sorry. Yeah. So assets on the left, liabilities and stockholders' equity on the right. The some of the items that I want to quickly highlight here. So of course, let's start from the asset side. Current assets. You have current assets on top, right? So it is in the order of liquidity. Cash and cash equivalents, trading securities at fair value, AR, net of allowance, notes receivable, inventory, prepaid expenses, right? So current assets. Then you have investments. In investments, you have available for sale securities at fair value, held to maturity securities, investment in affiliates. So you can see here, you have something called trading securities, right? Which is a current asset. Then you have something called available for sale securities. Then you have held to maturity securities, right? And of course, securities could be equity or debt. That means, but this is your asset. These are your assets. That means you have invested in the securities of another company. You have invested in the shares of another company. You have invested in the bonds of another company, etc. So this classification of so when you invest in the securities of another company, okay, you have to first of all, if it is debt security, then you have to do this classification. You have to, the management, you as in the management of the company has to determine whether it's a trading security for them, whether it's an available for sale security for them, or whether it's a held to maturity security for them. And depending on that classification, it is going to be shown in the balance sheet. So if they decide that it's a trading security, then it will be shown in the current assets at fair value. If they decide that it is available for sale, then it will be shown in investments at fair value. If they decide that it is going to be held to maturity, then it will be again under investments, but not at fair value. Held to maturity securities are at amortized cost. So again, we'll learn all this later. Right now, I just want to highlight that yes, securities can be in the current assets. It can be under investments depending on what is the classification of that investment. And when I say management has to decide, that means basically it is the intention of the management whether they want to trade in that security. Trade means, I buy it today, I sell it tomorrow, or whatever. I buy it this week, I sell it next week, or even I buy it in the morning and sell it in the afternoon, intraday trading, right? So if I want to trade in that security, I will call it a trading security. If I want to hold it till maturity, if it's a 5-year bond, I want to hold it for 5 years, all the way till its maturity, then it's a held to maturity security. And if it is somewhere in between, I neither want to trade in it, nor I want to hold it till maturity. I just have, it's an investment. I will see when I want to sell it. Okay, I will sell it when there is need for working capital, or when the price is really going good in the market. So it's neither trading nor held to maturity. Then it is available for sale. So anyways, so that classification we'll learn about it later. Accounts receivable is net of allowance, right? So this is called the net realizable value, right? So AR is shown at NRV. Trading securities are at fair value. Available for sale is shown at fair value. Held to maturity is shown at amortized cost, right? So I'm saying this because sometimes you get questions on this. Inventory will deal with it later. Inventory could be lower of cost or market. It could be lower of cost or NRV. That depends on whether you are following LIFO, FIFO, which method are you following. The rule will depend on that. If you're following a certain method, then there will be a certain rule applicable to you. If you're following some other method, there will be another rule applicable to you, right? So basically the two rules are inventory is stated at cost, and then there are certain exceptions to this rule. The exceptions are inventory stated at lower of cost or market, and then another exception is it is stated at lower of cost or NRV. Now, what does market mean? What does NRV mean? How it is calculated? All that we will learn later. But inventory is basically valued at this, either cost or lower of cost or market or lower of cost or NRV. So it could be any of these. Continuing on the asset side only. Property, plant and equipment. So fixed assets are called PP&E, property, plant and equipment. Okay, this is the terminology that we use, PP&E, property, plant and equipment, where you have land, you have building, you have equipment. That's it. That means anything other than land and building will come under the category of equipment. So this is not equipment per se, this is the category equipment. So everything other than land and building will come under equipments. Of course, less accumulated depreciation. So accumulated depreciation is called a contra asset, right? So your land, building, equipment are assets, and AD is a contra asset which reduces the asset. So obviously in the outer column, you are going to show the net amount. And obviously land is not a depreciable asset, right? So land is the only exception where it is not depreciable. The other assets are depreciable. So AD would obviously pertain to building and equipment, not to land. Then you have intangible assets. And yes, by the way, PP&E is shown at historical cost. Okay, all that will come later, right? So whatever I'm telling you is all written in the book somewhere. Okay, later. So don't worry, you don't have to take notes, is what I'm trying to say. Just listen, just pay attention. That's it. You don't have to take any notes at this stage. Intangible assets, you have goodwill, you have patents, and there could be other intangibles. This is just an illustrative list. Goodwill is basically is an unidentifiable intangible, and the others, patent, copyright, trademark, logo, all those are identifiable intangibles. You can identify them. Goodwill is the only intangible which is called unidentifiable. You cannot identify goodwill because it's it's basically with the the name of the company or the name of the brand is the goodwill of the company or the goodwill of the brand. So you can't identify it separately, right? It's the business overall that has goodwill. Of course, we will see that it's not the overall business. It can be lines of businesses, it can be brands, it can be at a lower level also, goodwill can be there. But yeah, it still is unidentifiable. And of course, goodwill is not so property, plant and equipment are depreciated. Intangibles are amortized, right? As you can see here, patents net of amortization. But the same thing is not written against goodwill. It is not written goodwill net of amortization. Why? Because goodwill is not amortized. Goodwill is impaired. It is tested for impairment. Now, what is impairment? We will talk about it later. Okay, but goodwill is not amortized under US GAAP. Goodwill is impaired. Having said that, we will also see that there are certain rules that have been relaxed for private companies, right? Because see, US GAAP is very cumbersome. It's extremely big. And by the way, US GAAP is rule-based. IFRS is principle-based. So I hope you understand the difference between rule-based and principle-based. If you don't, then maybe I will explain it. But basically, US GAAP is rule-based. And so that makes it very, very cumbersome, very huge. Okay, because for everything you have to have a rule. And so that makes it very big. So if you pick up a US GAAP book, it's extremely fat, extremely thick, extremely fat, right? Now, obviously, complying with US GAAP itself can involve a huge cost. And for small players, small companies, private companies, small companies, it may be very difficult, to bear that cost. So there's a private company council, PCC, under the Financial Accounting Foundation. They have come out with certain relaxations that, okay, private companies need not follow all the rules of US GAAP. They have some waivers. So the private companies can amortize goodwill, but the US GAAP rule is that goodwill is not amortized. It is only tested for impairment. Of course, what private companies can do is an exception. It's a waiver given to them. That's not the rule. The rule is goodwill cannot be amortized. Goodwill is tested for impairment. Exception is, yes, certain private companies have been given this relaxation that, okay, because impairment testing is also expensive. You have to engage a consultant. Maybe you have to engage a Big Four to come and, do a valuation of your goodwill and see whether it has been impaired or not. I mean, you will have to spend money to even get it done, right? So, they have been given certain relaxations. But your other intangibles are amortized, okay? And then you have other assets like pension and other post-retirement benefit assets, deferred income tax. So again, these are topics that are highly technical in nature. We are going to pension, fortunately or unfortunately, is not part of your syllabus, right? They don't test you on pensions. Earlier, it used to be part of the CPA curriculum, but then I think it has been 2 years now that they have removed pensions, right? So pension used to be a very technical topic, very tricky topic. Most students used to find it challenging. So in that sense, you're lucky that it has been removed. But why I said unfortunately, because you will not gain knowledge of this topic, right? But yes, deferred tax is still part of your syllabus. We are going to cover deferred tax. Either in, they have deferred tax. I think they have moved to bar now. It is not a part of FAR anymore. So if you choose bar, then we will cover it. Yeah, and so deferred tax is a non-current item. You can see here it is coming after property, plant and equipment, after intangibles, so it's a non-current asset. And if it's a deferred tax liability, it's a non-current liability. So regardless of what gave birth to it, why this deferred tax was caused in the first place. Okay, so regardless of that, deferred tax is always considered a non-current asset or a non-current liability. Okay, regardless of what gave birth to it, and regardless of when it's going to reverse, right? Regardless of that, it is a non-current asset or a non-current liability, as the case may be. And of course, you are going to show the net amount. So if you have certain deferred tax asset items and certain deferred tax liability items, you are going to net it off and show it as one item in the balance sheet. You can't have both deferred tax asset and deferred tax liability in the same balance sheet. That is wrong. So you will net it off. If the assets are more than the liabilities, you will show it as a deferred tax asset. If the liabilities are more than the assets, you're going to show it as a deferred tax liability. Okay, so you'll net it off and show it as one amount. And regardless of what gave birth to it and when it is going to reverse, it is always going to be considered as a non-current item. So that's your total assets. That's your total assets. Okay, now let's go to the liability side. You have current liabilities. Current portion of long-term debt, very important. Long-term debt is of course non-current, but the current portion, what is due in the next 12 months or the operating cycle of the company, whichever is longer, right? So what is the definition of current? 12 months or the operating cycle of the company, whichever is longer, that's current. That means if the operating cycle of a company is 15 months, then obviously 12 or 15, which is longer, 15. So in that case, any any payment that is due in the next 15 months will be considered as current. So if you have taken a 10, let's say 10-year loan, and you're paying back in installments, so whatever is due in the next 12 months or the operating cycle of the company, whichever is longer, whatever is due within that period will be considered as the current portion of the long-term debt and is classified as a current liability. The rest of it will be considered as a non-current liability. So out of, let's say, out of $1 million, if you have to pay 100,000 in the next 12 months, then 100,000 is current portion of that debt, and the remaining 900,000 is non-current liability, right? So the loan of $1 million will be broken into two parts: 100,000 current, 900,000 non-current. So current portion of long-term debt is a current liability. Operating cycle can be lower than 12. Yes, absolutely. If the operating cycle of a company is 9 months, then we will consider whichever is longer, 9 or 12, whichever is longer. So we will take 12. In that case, current will be anything which falls due within the next 12 months, right? So if it is 9 or 12, we'll take 12. If it is 12 or 15, we'll take 15, whichever is longer. Okay. Yasmin, do we refer to the cash? Yes. So we are referring to the operating cycle, which was actually part of BEC. Now we will learn what is an operating cycle. We will learn in BAR. Okay. But I hope, Vivek, you have got your answer, right? It is yes. Yeah. Cash operating cycle. Okay. Accounts payable, notes payable, interest payable, salary payable, unearned revenue. Unearned revenue is something that you have received in advance. You have not yet delivered the service. It is unearned, so it's a liability right now. When you provide the service and you earn that income, then it will move from unearned revenue to earned revenue. That means it will go to the income statement, right? So P&L is called income statement in US. Then you have long-term liabilities, bond payable, if you have issued bonds, right? Bond payable, deferred tax liabilities, as I said, it's always a non-current item. Pension and other post-retirement benefit liabilities, not a part of your syllabus anymore. Then you have stockholders' equity. And in stockholders' equity, you have capital stock, in which you have preferred stock as well as common stock. Then there is something called paid-in capital in excess of par. In excess of par, that means basically premium, right? But there are other items we will see in stockholders' equity. There are 2 separate modules on stockholders' equity where we will talk about this entire stockholders' equity section in detail. This paid-in capital in excess of par is also called APIC, additional paid-in capital, right? So it is commonly referred to as APIC, additional paid-in capital. Then you have retained earnings. So typically, this stockholders' equity section is called CAR, 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 common stock C, APIC A, and retained earnings R. So this is your CAR, common stock, capital stock, additional paid-in capital, and retained earnings is your stockholders' equity, and also accumulated OCI. What is OCI? We will talk about it. But there is an item called accumulated OCI that comes in the stockholders' equity section on the liability side of the balance sheet. Okay, so typically there are these 3 or 4 items: capital stock, additional paid-in capital, retained earnings are definitely there in most balance sheets. AOCI may also be there in some balance sheets. Then, of course, treasury stock at cost. Treasury stock means basically your own shares that you have bought back. This is basically buyback of shares. So company's own shares that the company has bought back from its shareholders, that is called treasury stock. So that could also be there in the stockholders' equity section. And if it's a consolidated balance sheet, that means you have consolidated the parent and the subsidiaries, financials into a consolidated one. Then you might also have an item called non-controlling interest, right? Non-controlling interest. It's called. It's not called minority interest. It's called non-controlling interest, right? NCI. So typically these are the items: CAR, common stock, capital stock, APIC, retained earnings. Then apart from that, you have AOCI, accumulated OCI. You have non-controlling interest, NCI, and of course you could have treasury stock. That's your total stockholders' equity, and then of course the total of the liability and stockholders' equity should match with the total assets, right? Obviously, and that is why it is called a balance sheet, right? Because it must balance. Okay. Now let's go to the top. Very important para over here. Under US GAAP, general purpose financial reporting is defined as a full set of financial statements and notes to the financials. Very, very important line. Why it is an important line? Because there are 2-3 things that are being covered in this sentence. First of all, it says general purpose financial reporting. So US GAAP is a general purpose financial reporting. Even IFRS is a general purpose financial reporting, because there are some special purpose frameworks available for financial reporting, right? So special purpose frameworks are called other comprehensive basis of accounting, OCBOA, other comprehensive basis of accounting. And in that, you have things like regulatory basis of accounting, income tax basis of accounting, contractual basis of accounting, cash basis of accounting, hybrid. Hybrid means it has features of both cash and accrual system, right? So that's called hybrid. So there are different types of frameworks available for preparing financial statements. US GAAP is a general purpose financial reporting. It's not a special purpose framework. Special purpose framework is where under special circumstances you prepare your financials under that framework, right? So if you have, for example, for income tax purposes, you are preparing your financials under income tax basis of accounting, or you are such a small player that you don't need to follow accrual system, you are a shopkeeper, you are following cash basis of accounting, right? Or let's say you have taken a loan from a bank and the bank has asked you to prepare financials in a certain way following certain rules, right? Then it's contractual basis of accounting. Or you are preparing financials under some regulation, right? Electricity Act, Insurance Act, then that is regulatory basis of accounting. So those are called special purpose frameworks. US GAAP is a general purpose framework. So this word general purpose is very important over here. Even IFRS is a general purpose framework, right? And another important aspect which is covered here is full set of financials. What is a full set of financials? What does it consist of? So it consists of 5 things. It consists of 5 things: statement of financial position, which is the balance sheet; statement of earnings, which is the income statement; statement of comprehensive income; statement of cash flows; and statement of owner's equity, right? This is actually statement of changes in owner's equity, but fine. So these 5: statement of financial position, balance sheet; statement of earnings, which is income statement; statement of comprehensive income; statement of cash flow; statement of owner's equity, plus the notes. Notes are always an integral part of the financials. Always. Notes are always an integral part of the financials, right? So here also they have mentioned and notes. Even if they had not mentioned this, notes are always an integral part of the financials. And why are financial statements called financial statements? Because they are statements, right? These are all statements. And of course, they are financial in nature. So that is why financial statements. So, and it is plural, right? Because it is not just one, there are 5 of them, right? So it's plural. These are statements. These are not accounts. These are not accounts. It's not a P&L account. It's a statement. Okay, so there are 5 statements that make up the full set of financial statements, and notes are always an integral part of the financial statements. Full set of financial typically include these 5. Yes, it's another matter that you can combine the income statement of earning and statement of comprehensive into one. If you are combining them into one, then you will only have 4 items in your full set, right? In that case, you will not have 5 items in your full set. But yes, if you combine, if you don't combine, then you'll have 5. And even if you combine, you are basically, showing the whole thing, but in just one statement. Just like if you remember in class 11th, you used to do trading and P&L, and you used to cover it in one. The top part used to be trading, and then the lower part used to be P&L, right? So you would break it with gross profit. You would break it here with gross profit, and you would take the gross profit down and continue, and then you would arrive at the net profit, right? So you used to break it down into 2 parts. The P&L would be broken into 2 parts. The first part would be trading. The second part would be P&L. Similarly, if you are combining the statement of earning and statement of comprehensive income, you are presenting it as in one statement, but you are showing the items of both, right? Entities may present a classified balance sheet that distinguishes current and non-current assets and liabilities, right? When appropriate, a balance sheet presentation based on liquidity is also permissible. Following is an example of a classified balance sheet. So this balance sheet is, as I mentioned earlier, it is in the order of liquidity. You can also prepare a balance sheet which is in the order of permanency. That means you show the non-current, the most non-current item on top, and the least the least liquid item at the end. So you can completely reverse it also, right? So it is liquidity in order of liquidity or in order of permanency. And classified balance sheet means where you classify the items as current and non-current separately, right? So you identify the current separately and put them at one place together. You identify the non-current and put them at one place together, right? So that is called classified balance sheet. Okay. Okay, so before I go to income statement, let me quickly take your questions. When we count 12 months or operating cycle from the end of the calendar year. Yes, I mean, see, you would you would know what's your operating cycle of of your company. Once you know that, you have to see which one is longer. So it is, if it is 9, then 9 or 12, 12 is longer. If it is 12 or 15, then 15 is longer. And so obviously, yeah, from the balance sheet date, that time. So if it is 9 or 12, then 12 months from the balance sheet date. If it is 12 or 15, then 15 months from the balance sheet date, right? Would be considered as current. Okay, Amandeep. Ankit, unearned revenue and deferred revenue are same. Can we assume unearned revenue are booked as revenue within same operating cycle? Well, okay, so this is basically income received in advance. Okay, income received in advance. You have not earned it yet. You have just received the money. But we are obviously in US GAAP, we are following the accrual basis of accounting. So you have not earned this money. So you cannot treat it as your revenue in the income statement. So therefore, it is shown on the liability side. So and it will go to revenue when you earn it. When you earn it, okay. And yes, typically yes, it is within the same, within the next 12 months or the operating cycle, whichever is longer, right? So typically, you would not receive something, in advance 3 years before time or 2 years before time. Normally, you will receive something in advance, maybe a few months before time. So typically, it falls right under, and I know why you're asking this question, because it is given under current liabilities, right? So your question is, what if if we are going to earn it after the operating cycle of the company? Now technically speaking, what is operating cycle? So this discussion we are going to have in bar, but basically, what is the operating cycle? Yeah, when you will manufacture the item, you will sell it, you will receive the money from your accounts receivable party, right? So that is the operating cycle, right? So for a pen manufacturing company, operating cycle could be very low. For a aircraft manufacturing company, operating cycle could be very big. Or a submarine manufacturing company or a ship manufacturing company, operating cycle could be very big. For a pen or a shoe manufacturing company, it would be very small. But if you think of it technically, we are saying that obviously we will make the ship, deliver the ship to the customer. That means within the operating cycle only we'll do it, right? That's how we have calculated our operating cycle, that how much time does it take for us to manufacture it, for us to sell it, and for us to recover the money. That is our operating cycle. So if it takes 15 months to do that, then 15 months is our operating cycle. So obviously, if somebody has given us an advance for manufacturing a ship for them, right, we would have earned that within the next operating cycle, because we would have manufactured the ship, we would have given it to them, and we would have earned that money. Are you getting my point? So it, technically speaking, it will not go beyond the operating cycle of the company, typically, right? And that is why it is under current liabilities. Is that clear? Does it make sense? Ankit, yeah? Yasmin, where intangible assets other than goodwill will be covered? Under the same category. So it was there under intangible assets. Patent is, is an intangible only, other than goodwill, right? So it will be covered. All your other intangibles, copyright, trademark, logos, brand name, all that will be covered over here only. Is that clear? Yes, Yasmin, all your intangibles will be covered under one category there. Okay. And is the operating cycle of 12 months lower or higher for current assets, current liabilities? No, it is of the company. It is not of current asset or current liability. Operating cycle is of the company. So it is going to be consistent, right? You cannot have 12 months as operating cycle for current assets and 15 months as operating cycle for current liability? I mean, if that is your question, if I'm getting your question correct, you cannot have different operating cycles. Your operating cycle will be defined as for the company, that this is the operating cycle of the company. And then you will determine what are your current assets and what are your current liabilities based on that. Okay. All right, so let's proceed. Income statement. So balance sheet we are done. Statement entities may present classified balance sheet. See, classified is where you break it down into current and non-current. That's called a classified balance sheet. So it says entities may present a classified balance sheet that distinguishes current and non-current assets and liabilities. Right? Like here, this balance sheet that they have shown here is a classified balance sheet because they have distinguished the assets. They have classified the assets into current and non-current. The ones that are current are shown at one place under the heading current assets. The ones that are non-current are shown separately, together of course, but separately from current under the heading non-current, right? So that is called a classified balance sheet. There is another term used for this, which is called marshalling of the balance sheet, right? It's a marshaled balance sheet, right? But in US, they don't use the word marshal. They use the word classified, okay? Classified balance sheet. Is that clear? If a company has different products which have different operating cycles, which are okay. So if you see the intent is whichever is longer. So obviously, if you have different products with different operating cycles, you will take the one which is longer. Okay. Is that clear? And Amandeep, you say it's not mandatory. So yeah, I mean, it's not mandatory. Okay, so let's proceed now to income statement. Uses of income statement and the terminology. Purpose of income statement is to provide information about uses of funds in the income process, which is called expense. So you're using funds to generate income. Uses of funds in the income process means you are basically using the funds to generate revenue. That's called expense, right? Uses of funds that will never be used to earn income, that is called losses. Where you have used some funds, but it will not generate any revenue. It will never be used to earn income. Okay, that's called losses. So in US GAAP, expenses and losses are shown separately. They are separate. Obviously, they are separate items and they are shown separately. And also, revenues and gains are separate items and they are shown separately. Right? Sources of funds created by those expenses are revenues. Right? So you used up funds to generate revenue, and when the revenue got generated, then obviously it is revenue. And the source of funds not associated with the earning process is gain. Right? So here comes the concept of core operations. What is the core operation of the company? Right? So like I said, if it's a pen manufacturing company, then manufacturing and selling pens is the core operation. And so when you sell pens, that is revenue. But if you also happen to sell a piece of furniture, then it is gain on sale of furniture. It's a gain item, not a revenue item. Right? If you are a pen manufacturing company and you have sold a piece of furniture, then that will come under the gain category, not revenue category. But if you are a furniture manufacturing company and you are selling furniture, then that's a revenue category. So it is not the item that will determine, right? Because the item is same, it's furniture, but for one company, it is a non-operating item, will come under gain. But for another company, it's a operating item and it will come under revenue. Item is the same, it's a piece of furniture. So it is not the item that determines whether it should go to revenue or gain. It is the core operations. What is your core operation? For a pen manufacturing company, selling furniture will come under gain or loss on sale of the furniture. And for a furniture manufacturing company, it will come under revenue. So when you attempt questions, you must be very careful in reading what is the, if the question has given that information, then you have to consider that information, that what is the core operation of this company, because accordingly, your classification here will change. Okay. And of course, if the question is silent, then you will consider it as a non-finance company. That means basically it's, let's say, a manufacturing company. But yeah, what are they manufacturing? The question will tell you. If they don't tell you, then, obviously they'll not ask you questions based on that. But yeah, you can assume that it's a non-finance company, right? Because if it's a finance company, then they will specify it. Because for a finance company, even like interest will be a revenue item. Okay, because they are in the business of, let's say, giving and taking loans. So interest is an operating item for them. That's their core operations. So interest is an operating item for them, and interest revenue will come under revenue, not as a non-operating item. Okay, normally for a non-finance company, interest is a non-operating item. Okay, so these are certain things that you have to keep in mind. Okay, now let's proceed. Uses of the income statement. Income statement is useful in determining the profitability, value for investment purpose, and credit worthiness. Income statement is also useful in predicting information about future cash flows, the amount, timing, and uncertainty of the cash flows based on past performance, right? So although the income statement is prepared, for the year that has already gone by, so that is why these are called historical financial statements, right? The financial statements that we are going to talk about in FAR are the historical financials. Historical means the time that has already passed. So if 2022 is over, and we are preparing the balance sheet and income statement for 2022, that's obviously the year is over. That's called historical financials. When we do audit, you will see that we also talk about prospective financials, projections, forecasts. Those are forward looking. Here in FAR, the financials that we are talking about are historical. Okay, but this last line also means that yes, of course, the income statement is historical, but it also gives you a sense of what the future year is going to look like, right? Which is called predictability. Okay, so there are certain qualitative characteristics of financials, right? The financial information or financial statements must have certain qualitative characteristics, and one of the qualitative characteristics is predictive value. That means by looking at this year's financials, you must reasonably be able to predict how the next year's financials are going to look like, or how the company is going to perform in the coming year, right? So that is called predictive value. Obviously, it is based on past performance, right? But it is useful in predicting the future, but based on past performance. Okay. All right. Now coming to the next terminology here. I mean, the next item here is cost and unexpired cost. So what is this concept? This concept is that, if this is your balance sheet and you have a building over here, which is a capitalized, a capital item, right? You have capitalized it and it's there in the balance sheet. It will eventually go to the income statement by way of depreciation, or let's say any other item, right? Any other item, equipment. So if there is an equipment in your balance sheet, right, of $100,000, and it has a 10-year life, it will go to the income statement of the next 10 years. If I consider SLM, straight line method, then $10,000 of year one income statement, $10,000 in year two income statement, $10,000 in year three income statement. So eventually this 100,000, this entire 100,000 is going to land up in the income statement, but not in one go, over a period of time. So right now, this $100,000 is called unexpired cost. It is called unexpired cost. And slowly it will expire. Year 1, 10,000 will expire. Year 2, another 10,000 will expire. Year 3, another 10,000 will expire. And by the end of the 10th year, the whole thing will expire. Right? So from unexpired, it will become expired. Right? So if you see here, unexpired, all the arrows are going to the right. It becomes expired. So if you see here, fixed assets expire by way of depreciation. Patents, intangibles expire by way of amortization. Inventory expires by way of cost of goods sold. When it is inventory, it is a balance sheet item. The moment you sell that inventory, you book the cost in the income statement as cost of goods sold. So obviously from the balance sheet inventory, it has gone to income statement as cost of goods sold. So it has expired. So, that's the term they use. So so for every unexpired item, there is a corresponding expired item. For inventory, it is cost of goods sold. For prepaid expenses, it is the respective expense. So if it is prepaid insurance, then insurance expense is the expired cost. For fixed assets, depreciation is the expired cost. For intangibles, amortization is the expired cost, and so on. Okay. So cost is amount measured in money expended for items such as capital assets, services, payroll, merchandise. Cost is the amount actually paid for something. So basically, cost is something that you have expended. Unexpired costs are costs that will expire in future periods and be charged against revenue. Against revenue means they will go to income statement. Charge against profit means income statement. And appropriation of profit means not income statement. Appropriation of profit means it will go out of, let's say, retained earnings, right? So dividend, when you pay dividend to your shareholders, it is not a charge against profit. That means dividend is not an income statement item. It is an appropriation of profit. You pay dividend out of your profits. So first you calculate profit, revenue minus expense is your profit, and then you pay dividend out of that. So dividend is not a charge against profit, it is an appropriation of profit. But these expenses are these are charge against profit. Charge against revenue means charge against profit, but from future periods. Right now it's a balance sheet item. Right now the fixed asset is sitting in the balance sheet. It's unexpired cost. In the future periods, it will be charged against revenue. So that is called unexpired cost, which will expire in future. And as I said, revenues are separate from gains and expenses are separate from losses under US GAAP. And the primary distinction is that this is in exchange for goods and services. In exchange for goods and services. That means this is the core operation of the company. The company manufactures certain goods or provides certain services. And so when we talk about that, that is revenue. And if gains is not in the ordinary course of business. Gain is recognition of an asset either not in the ordinary course of business or without the incurrence of an expense. Finding gold on the company's property. Right? So that's also a gain. And by the way, there is another concept of gross and net. And here net does not mean net of income tax. Here simply net means that you are going to show. So for revenues, it is gross. Revenue is shown at gross. That means when you prepare the income statement, you show your revenue, right, which is also called net sales, right? And this is also called revenue from operations, RFO, right? So if there is a $80 item which I have sold for $100, then in revenue I'm going to show $100 gross, and less cost of goods sold I will show 80, and then I will show gross margin of 20. So I'm showing revenue at the full 100 and the cost of goods sold at the full 80. So this is a gross amount. This is a gross amount. And then the 20 is the net amount. So we are showing the gross. But in the case of gains, gain on sale of furniture, if I sell a furniture which was $80 and I sell it for 100, I made a gain of 20. In the income statement, I'm simply going to show the gain on sale of furniture. Gain on sale of furniture, straight away 20. I'm not going to show 100 and 80 separately. So this is called net. So that is why they are saying that revenues are shown at gross, but gains are shown at net. Similarly, expenses are shown at gross, but losses are shown at net. So revenues and expenses, which are the operating items, are shown at gross. The non-operating items, gains and losses, are shown at net. Is that clear? So here the concept of gross and net is in a different like the different context or perspective, not from a tax perspective, right? So here we are not talking about tax here. All these items are gross of tax. Okay, all these items are gross of tax because in the income statement we will show tax below all these items, right? So somewhere after, and I'm going to show you an income statement in just a moment, but less provision for tax will be later. That means anything above this line, above the provision for tax line, is all gross of tax. Okay, so that's a different concept. Gross of tax and net of tax is a different concept. This gross and net is a different concept. And so costs that benefit only the current period or the allocation of unexpired costs to the current period are expenses. So depreciation is allocation of unexpired costs to the income statement of the current period. So that is also an expense. And costs that will benefit only the current period, like maybe let's say a salary to the employees, is also an expense, right? And gains and losses are not in the ordinary course of business. Or without the generation of revenue. That's a loss. Okay, now this note, unusual or infrequent or both, should be reported separately, but as part of income from continuing operations. So let me quickly just show you here that basically the income statement. So suppose this is your income statement, and of course I'm talking about the vertical format here, not the horizontal. Horizontal is like this, right? Is like the T account. So this is called the horizontal. And why is it called horizontal and why is this called vertical? Because for obvious reason that here things are placed side by side. Things are placed side by side, right? Side by side. So it is horizontal. And here things are placed one below the other. So it's vertical. Simple reason. So horizontal and vertical. So here, I'm talking about the vertical income statement. Just one second. Yeah, so in the vertical income statement, you have two major sections of the income statement. One is called continuing operations, and the second one is called discontinued operations. discontinued. And then the total of those two will give you the net income. Right? The total of those two will give you the net income. So this is the continuing operation section, this is the discontinued operation section, and the total of those two will give you the net income. Now, discontinued operation is a separate topic which we'll talk about. But if a company does not have any discontinued operation, then of course, this itself will become the net income because they don't have the discontinued, right? So in some cases, the income from continuing operations will become the net income. In some cases, the continuing plus discontinued will become the net income, right? So that depends on whether the company has any item to be shown under discontinued operation or not. But yes, if they have, then there are two sections, and this is the order. You have to show the continuing operations first, then the discontinued, right? So it has to be in that order. And the other thing is continuing operations, the items are shown as gross of tax, and discontinued are shown net of tax. Because you have the before net income, you have provision for tax line, right? So your net income, when we say net income is always after tax. Net income means it is after tax, right? Otherwise, we would have called it earning before tax, EBT. Earning before tax, less tax is net income, right? So if I don't mention net income after tax, if I simply say net income, that itself means that it is after tax. Okay. So obviously, if it is after tax, then anything below this line has to be shown net of tax. So remember this, that discontinued operations are shown net of tax. Continuing operation items are shown gross of tax. And within this, revenues and expenses are shown at gross. This is the different gross. This is not the gross of tax I'm talking about. This is the different gross I'm talking about. And gains and losses are shown at net. Is that clear? So there are two gross and net concepts we are talking about. One is the simple gross and net concept. And the second one is the gross of tax, net of tax, gross of tax and net of tax concept. Okay, I hope you understand this distinction. Now, this last thing that we read was that unusual or infrequent items, or both means it is both unusual and infrequent. So, or means something which is unusual. Infrequent means something which is infrequent. And both means something which is both unusual and infrequent. Now, this distinction is not relevant anymore. Earlier, it used to be relevant because you or I used to be shown at a different place. You and I used to be shown at a different place. But that distinction is not there anymore. So now it does not matter whether it is simply unusual or it is simply infrequent or it is both unusual and infrequent. It does not matter. As long as it meets any of this, it is going to be shown separately, right? You will not merge it with the normal, your regular expense items or your regular loss items. It is going to be shown separately as a separate line item, but in the income from continuing operation section. Not in a different section. Within the income from continuing operation section, you're going to show, but in a separate line. You're not going to merge it with your expense or losses. So, let's take an example. Suppose, see, tornado. A tornado is an unusual thing, right? So it is definitely an unusual thing. But let's say in Florida, tornadoes are very frequent, right? So it is unusual, but it is not infrequent. But it is, it is not infrequent. It is frequent. So a tornado in Florida, a tornado in Florida is unusual, but not infrequent. But let's say a tornado in, let's take some other, in Ohio, is unusual and infrequent, right? Because tornadoes don't happen in Ohio. So if it happens, it's an infrequent item, right? But in Florida, it is not an infrequent item. It's a very frequent item. Okay. But anyways, this distinction is not important anymore, as I said. Whether it is a tornado, whether you have a factory in Florida, right, where you had a tornado and you had certain losses due to that tornado, right, you are going to show it as a separate line item in the income statement. You're not going to show it under the normal, your loss on sale of furniture and loss of sale of some other asset. You're not going to club it with this line. You're not going to club it with this line. You're going to show it separately. Similarly, if you had a factory in Ohio and there was a tornado and there were losses due to that tornado, you are still going to show it as a separate line. You're not going to club it with your normal loss. Okay, so that is what this last line meant. That items of income or loss that are unusual or infrequent or both should be reported separately, but not in a separate section. It must be reported separately means in a separate line item, not in a separate section. It will be within the income from continuing operations section only. Nature of the item and the financial statement effect should be disclosed on the face of the income statement or in the notes, right? So you have to give the nature of the item and the financial statement effect, right? Either on the face or in the notes, so that you have a choice on the face or in the notes, the disclosures, nature and effect disclosed on the face or in the notes. Okay. So income from continuing operations, there are two options here. You can show a multiple step income statement, right? A multiple step income statement, or you can show a single step income statement. Both are allowed by US GAAP. What is the difference between these two? Let's see. So this is an example, right? So they have given you the trial balance of a company. Not the entire trial balance, only the income statement accounts, right? So you have sales revenue, sales returns, sales discounts. So you show the net sales, 380 minus 30, that means 350. So if you see the sales revenue, if you go to the answers page, if you see the word here, it is net sales. Obviously, they have other items, so that is why it's not 350. So this is, but this item will be 350, what we just saw. Then let's see what other items they have. Service revenue of 200 and rental revenue of 100. Right? So this 380 minus 30 is one item, which is 350. Then you have service revenue, rental revenue of another 200 and 100. So that makes it 650. But it is net of returns and discounts. We have already netted it. That's why it is 350, right? So we have already netted it. Now see, again, we just said that revenue is going to be shown at gross. Now we are saying it is shown at net. So this gross and net have been used in different contexts. This 350 is a net of returns and discounts. Yes, it is a net of returns and discounts, but still we are calling it a gross amount. Why? Because we are going to show the cost of goods sold separately, cost of services sold separately, cost of rental income separately. We are not going to net this off and show only the profit amount. So I hope you're getting the distinction here. Although this is net of discounts and returns, but still we are referring to this 650 as the gross amount. So if you go to the income statement now, you will see that cost of goods sold 200, this 150 and this 60 are being shown as a separate line item. $410 cost of sales, right? This was 350 plus 200 plus 100. That is 650. And this was, if I remember correctly, 200 plus 150 plus, I think it was 60. Let's see. 200, 150 and 60. Yes. Right. So that makes it 410. Right. So now you have 650 minus 410, gross margin of 240. And see again, the term is gross margin, but actually it's a net amount of revenue minus cost of sales, right? Net sales minus cost of sales is your net amount, but it is called gross margin. Okay, because we are going to use the word net income after everything else, right? So that is why here we are using the word gross. So, you know, there is this, I would not call it an oxymoron, but you know, something which is gross is being called net, something which is net is being called gross. Don't get confused. I hope you understand the exact concept. Net is net of returns and discounts, right? Because it says less discounts and returns. So that is why it is net, but actually it's a gross amount. And this is also a gross amount. So gross minus gross is the net amount, but we call it gross margin. It's funny, but that's how it is. Okay. Now, so till this point we are done. We have covered the trial balance till this point. Right. So we have taken the three items of revenues. This was one item of revenue, service revenue, rental revenue. This, of course, was net. Right. So one item, second item, third item of revenue, and the corresponding costs. Right. So this is the cost for the first item. This is the cost for the second item. This is the third cost for the third item. So now we have taken all of this. Then we come to, after gross margin, we show all these other salaries, freight out, commission, advertising, insurance, depreciation, income tax expense, interest revenue. This is another revenue, but we have not shown it with our sales and service and rental revenue because these are our operating items. And interest is our non-operating revenue, non-operating item. And obviously here we have assumed that it's a non-finance company. Their core operations is not giving and taking loans. It's not a finance company. Their core operation is, and let's see if they have mentioned anything here. Contains a, no, they have not mentioned anything here, but still our assumption obviously would be, and the fact that they have used the word revenue, the very fact that they have used the word revenue over here means this is the operations. Okay. Of course, they have used the word revenue for interest also. They have said interest revenue, right? But this is a non-operating item, and this is a safe assumption to make that this is a non-finance company's trial balance. So interest revenue is going to be shown separately under non-operating items. Okay. Okay. So let me show you. Let us go to the income statement. 1 second. Let's just complete this list first. So you have interest revenue, other revenue. Then you have gain on sale of available for sale securities. You have interest expense, loss on sale of fixed assets, right? Then you have restructuring expense. Restructuring is not something that a company does every year, right? Restructuring, you know, maybe once in 10 years, once in 15 years, a company will do a restructuring. So this could be an unusual, infrequent item, right? So that means it has to be shown separately. Although in the income from continuing operation section only, but separately. Okay. So this is one item that you have to be careful about. Then of course, they also have discontinued operations, and see, discontinued operation is shown net of tax. So now this income statement will have two parts, the continuing and the discontinued, and then the total of those two will give us the net income, right? And this is gross of tax, this is net of tax. Already they have given us the net of tax amount, so there's no problem, right? So we are going to show all these items. These are all non-operating items. And this is unusual, infrequent, has to be shown separately. Discontinued is a totally different section. Okay, so all this you have to keep in mind. And I think they have given some note over here also about restructuring infrequent. Okay. And for salaries, they have mentioned that 20 relates to salary of salespeople and 50 relates to salary for officers of the company. Now, why this is important is if it is for salespeople, then it is a selling and distribution expense. And if it is for officers, then it is, general and administrative expense. So the classification would be different. So salary total we have is 70. Out of this 70, 20 is sales, 50 is office, right? So after gross margin, you have selling expenses, general and administrative, depreciation, and then you get income or loss from operations, right? So before this, it was all your operating items. So this is called the operating section, right? Then you have the non-operating, other revenues and gains. So here you have interest revenue, gain on sale of available for sale securities, other revenues. Then you have the expenses, interest expense, loss on sale of fixed assets. So up to this is all this is your non-operating. Then this is your unusual or infrequent or both line, unusual or infrequent or both restructuring, which is shown separately, right? And then you have income before income tax. Income before income tax. So first is you had gross margin, 240. Then income or loss from operations. Then you have income before income tax. Then you have income tax expense. And after doing that, you get your income from continuing operations. If there was no discontinued operation, then this would have been net income. This would have been net income. But in this question, they have discontinued operations also. So therefore, this is not the net income. Therefore, this is not the net income because we have discontinued operations also. And then after adding income from continuing and discontinued 50 and this 25 plus or minus whatever it is, then you get the net income, right? So obviously if it was a positive number, it would have been 75, but this one is loss. Discontinued operation is a loss. So it is netting it off. So net income is reducing from 50 to 25. Is that clear? So you have up to this point is continuing operations. This is discontinued operations. The total of these two is your net income. And within continuing operations, you have operating, you have non-operating, you have unusual, infrequent, or both as a separate line item. Important thing to note here is that interest is a separate line item. Both interest revenue and interest expense are shown separately in the income statement. You cannot club interest with any other item, right? Similarly, depreciation is a separate line item in the income statement. Although depreciation is a general and administrative expense, but it is shown separately. It is not considered as part of the, for presentation purposes, it is a separate line item. It is not clubbed with general and administrative. You cannot say general and administrative is 150 and not show this line. That will be wrong. If you don't show the depreciation line and say general and administrative is 150, that will be wrong. So you have to show depreciation separately. Is that clear? So these are some things that you need to keep in mind. Now let's go to the single step income statement. Single step basically means you put all the revenues at one place, you put all the expenses at one place. So here you do not have a bifurcation of operating, non-operating, unusual, infrequent, all of that. Basically, you have put everything at one place, all your revenues at one place. Sales revenue, service revenue, interest revenue, rental revenue, gain on sale of available for other revenue, everything at one place. So you have total revenues. You have put all your expenses at one place. Cost of goods sold, cost of service sold, cost of rental income, selling, general administrative, interest is still a separate line item, depreciation is still a separate line item, right? And here also interest was a separate line item. So loss on sale of fixed asset, restructuring, income tax expense, all your expenses at one place. You straight get to income from continuing operations. Discontinued is separate line item and you get net income. So this is called a single step income statement. This is of course far more simpler, right? You are breaking the income statement only here just once. You're breaking it here at 50. Then you are adding discontinued to get net income. There you are breaking the income statement at 2-3 places. You're first breaking it here at the 240 level, gross margin. Then you are breaking it here, income or loss from operations. Then you are breaking it here, income before income tax. And then you're finally getting income from continuing as the fourth item. And then of course you have the fifth item discontinued. Then finally you have the net income as the sixth item. Whereas here you are breaking the income statement only at this 1000. I'm not calling this as breaking the income statement. This is just a subtotal. You are breaking the income statement only here at 50. 1000 minus 950, 50, and then 2, and net income is the third item. There it was the sixth item, right? So these are some minor things that you have to keep in mind. But regardless of whether it is multiple step or single step, interest is a separate line item, has to be shown separately. Your unusual, infrequent has to be separate line item, has to be shown separately, right? The placement might be different, but they have to be shown separately. Okay, so now we will start with discontinued. Before that, let me take your questions. Nature / effect on face not clear. See, I mean, on the face also, you can give a footnote, right? On the face of the income statement means on the page where you are displaying the income statement, on that page, you can give a footnote. Or you can disclose it in the notes, which is at the end. Is that clear, Yasmin? On the face or in the notes, right? You have a choice. You can disclose it anywhere, but you have to disclose the nature and the effect. Whether you show it on the face or in the notes, that's your choice. Is that clear? Discontinued operation is always net of tax? Yes. Discontinued operation is always net of tax. Anything that comes below the tax line is going to be shown net of tax. Okay. Then Jinish, income tax is calculated by adding income from continuing operation plus discontinued operation. Well, if you're talking about how to present it here in the income statement, that is a different question. And if you're talking about how income tax is computed, then that's a different question. I'm assuming that you're asking, because you're using the word calculated, you are asking how income tax is computed, how it is calculated. So income tax is not calculated as per US GAAP. Income tax is calculated as per IRC, the Internal Revenue Code. That means basically you have to follow the tax laws, the tax rules to calculate income tax, right? And so that's a different topic. We are going to cover it in deferred taxes, income taxes and deferred taxes. It's a separate topic. So income tax is never ever calculated. Okay, let me show it to you here. When we are preparing the income statement, so suppose this is the continuing section, this is the discontinued section, and then you have the net income, right? After you add the two. So continuing, discontinued, this plus this is your net income. Here you have income from continuing operations, right? Income or loss from continuing operations. Here you have income or loss from discontinued operations. And the two will give you the net income. So when you have income or loss from continuing operations, before this you have less income tax. And before this you have all your other items. So operating section, non-operating section, right? Unusual, infrequent, all that. And then you have less income tax, right? What we just saw. This income tax, whatever this amount is, X amount, is never calculated on the line before this. So here you had income before income tax. Income before income tax, correct? Suppose your income before income tax was $1,000 and income tax rate is 30%. That does not mean that income tax will be 300. Never. Never ever. You never calculate income tax based on your US GAAP number. This income before income tax is a US GAAP number. You have derived it, like basically this is your in your financial statements. So you never calculate income tax based on financial statement numbers. You always calculate income tax based on your tax return, which is prepared following the Internal Revenue Code. Is that clear? Was that your question? Did I get your question correctly? Yes? Okay. Okay, so let's go back to the, sorry, let me take the other questions. Janish, yes, done. Okay, then Amandeep, why gain and loss is shown separately if it is a net concept? See, gains and losses under US GAAP are shown separately because they are non-operating items, right? They want to show the how much you have earned from your operations separately and how much you have gained or lost due to non-operating items. They want to show it separately. It's basically about transparency. You want to be more transparent. You want to give out more details, to your shareholders, to the users, so that they can see that, okay, from the operations, core operations of the company, how much the company has earned, right? So if you look at this particular example that we have discussed, the company had gross margin of 240, but there was a loss from operations of 10, right? So they want to show this separately, and then other revenues and gains and all this is converting it back from a loss to an income. Income before income tax is back again at a positive number of 150. But this is also because they have some other revenue of 130. They have interest revenue of 170, right? Then they also had a gain on sale of available for. So basically what I'm trying to say is that, one of the things that we saw that there has to be a predictive value, in the financials. One of the qualitative characteristics is that you must be able to predict. So the gain on sale of available for sale securities may not happen again next year. You may not have this other revenue next year. It depends on what this revenue is. We don't have the details here in this question, but this may not happen, again next year, or may not happen at this number again next year. So, so they basically, the US GAAP says that you have to show the operating section separately, so that the shareholders know, okay, what to expect, next year from this. Non-operating may happen, may not happen, depends. Okay. Basically, it is about transparency. Is that clear, Amandeep? Does it make sense? Gunjan, why not interest income and interest expense shown in on net basis? Again, see, like I said, US GAAP is rule based, right? So there are certain rules that that US GAAP follows, and you have to. I mean, we just have to go by that. See, okay, let me also, since you are asking these type of questions, let's have a 2 minutes discussion on this. US GAAP has certain set of rules. IFRS has certain set of rules. Indian GAAP has certain set of rules. German GAAP has certain set of rules. And if if there is a difference between, let's say, Indian GAAP and US GAAP, are we going to say that US GAAP is wrong, Indian GAAP is right, or Indian GAAP is wrong, US GAAP is right? Are we going to say that? I'm asking you. Are we going to say that? So see, they show assets on the left and liabilities on the right. We show assets on the right and liabilities on the left. Can we say that they are wrong, we are right? Or can we say that, we are wrong, they are right? I mean, do we do that? No. Answer is no, right? Uh, it is a matter of basically, okay, why do amendments happen? Okay, revenue recognition was a very completely different standard, till 2 or 3 years ago. Now it's a completely different standard. The entire revenue recognition standard has changed. Leases, the lease standard has changed. Okay, earlier operating leases were not shown as were not capitalized. Now, not capitalized in the sense, if you had taken an asset on operating lease, you would not show it in the balance sheet. The lessee, I'm talking about the lessee. Okay, lessee means the company that has taken that asset on lease from another company, right? So if it was an operating lease, earlier we were not showing it in the balance sheet of the lessee company. Now under the new standard, we show it in the balance sheet of the lessee company, even if it's an operating lease, right? So shall we say that the previous standard was wrong? Again, answer is no. The point that I'm trying to make is that, and it's a very general point that I'm trying to make here, is that, we are dealing with the real world. We are dealing with the issues of the real world. And so finance and accounting is also evolving as the real world is evolving, right? And that's the primary difference between an academic course and a professional course. This is a professional course, and in a professional course, you deal with issues of the real world, and the real world is dynamic. It is always evolving. So as the real world evolves, accounting and finance also evolves along with it. And so, maybe, somebody who had created the standard earlier thought that, okay, we should only show the finance lease in the balance sheet of the lessee. We should not show the operating lease in the balance sheet of the lessee. Then, somebody else, or a new team came up and they brainstormed and they thought, no, I think we should also show the operating lease assets in the balance sheet of the lessee company. Ultimately, they are using that asset. They are benefiting from it. And what is the definition of an asset? That, when you derive future economic benefit, right? That's an asset for you. When you derive a future economic benefit from something, that's an asset for you. So they are deriving future economic benefits, right? So that's an asset for them. So we should So what I'm trying to say is that, it's evolving. Similarly, if you talk about law, okay, I'm just digressing from the topic. Since you guys are asking these kind of questions, let's just put it at rest in one go. That in law also, okay, you must have seen a lot of times Supreme Court has overturned the decision of the High Court, completely overturned the decision of the High Court. Now, does that mean that the High Court judge was not a knowledgeable person? No, he was. He must have also have 15 years, 20 years of experience. He must have also read, 400 books. He must have given judgments on 5,000 cases or 50,000 cases, right? So he's also a very knowledgeable person. But when that same case came to Supreme Court had a different view about it, and they completely overturned the decision, right? That does not mean the High Court judge was not knowledgeable. So what I'm trying to say is that there is a certain rule. You may like it, you may not like it, you may want to challenge that rule. Perfectly fine. But we cannot say that this rule is wrong or that this should not be shown like this. I hope you're getting my point. It is just a viewpoint, right? In a certain gap, it is shown separately. In a certain gap, it is netted off against each other. In a certain gap, it may have a completely different treatment, right? Like deferred tax. I just told you deferred tax in US gap is always shown as a non-current item. In some other gap, okay, in UK gap, German gap, Australian gap, some other gap, maybe they show it, the non-current portion of the deferred tax as non-current, the current portion as current, right? So it's not about right or wrong. It is just a rule. Right now, this is the rule under US GAAP. Maybe in future, they might change this rule. Maybe it will not change. It will remain the same. Depends, right? So I hope you get the point, right? So our job is to know what the rule is here. At this point, as a student, when you're taking the exam, your job is to know what the rule is. Not kind of to challenge the rule. Okay, is that okay? Next question. So why not? I think I've given a very long answer to a short question. Gunjan. Next is theft of goods, damage of goods, etc. How it will be shown. Again, these are losses, right? So depending on when you say damage of goods, how that damage has happened. If it is due to an earthquake, then it will be shown under the unusual, infrequent, that line. If it's a normal damage, right, then it will be shown under your normal, losses under the non-operating. If it's a damage, which is inevitable and it is part of the manufacturing process. For example, in case of chemical industries, a little bit of chemical gets evaporated during the manufacturing process, or in case of a cement industry, a little bit of cement, while packaging, it falls on the floor, and once it gets mixed with dust, it cannot be used again. So it basically a damage. It depends on the situation and the circumstances. Okay, how much is considered as normal, part of the manufacturing process, what is not normal. Then if it is not normal, then it is non-operating. If it is normal, it is part of the operating, part of the manufacturing process, part of operations. And then if it is something because of earthquake or tornado or something, then it is absolutely a different category. So it depends on how, what caused it. Okay, Rohit. Next question, income statement, gross or net, how to decide? No, there is no question of how to decide. It's a rule. You have to show revenue at gross. You have to show gain on sale of furniture at net. You have to show continuing operations at gross of tax. You have to show discontinued operations at net of tax. These are rules. You just have to follow these rules. You don't have to decide. Right, Yasmin? Amandeep, if it is operating, then we will use net concept in gain and loss. See, the word gain and loss are not used in the context of operating. The word gain and loss are used in the context of non-operating items. So like I said, if you are a pen manufacturer and you have sold a piece of furniture and you have made a gain on that sale, it's a non-operating item. You will not say gain on sale of pen. You will not even use the word gain on sale of pen if you are a pen manufacturer. The word gain will not be used for operation, for your core operations. There you will use the word revenue and cost of goods sold. But if you're a pen manufacturer and you have sold furniture, then you will use the word gain on sale of furniture. So Amandeep, the word gain and the word loss are used in the context of non-operating items only, not in the context of operating items. Okay. So Kapil and Gunjan, you have said no to something. I will just come back to you. Just give me a moment, right? Otherwise, it is getting mixed up. I don't know for what you said no. So I'll just come back to you. Just give me a moment. Amandeep, in book, it is written that gains or loss, which is not in the ordinary course of business, means non-operating. Yes, yes. And you have said that it is based on net concept. Then why is the example we are showing separate? It is in the example we are showing separate. It is from non-operating activities. Amandeep, I'm not very clear about your question. Gains or loss, which is not in the ordinary course of business, means non-operating. Yes. And we use the word gain or loss when it is not in the ordinary course of business. So it is not in the ordinary course. If it is in the ordinary course of business, I mean, if it is part of your operations, then we don't use the word gain or loss. Right? And gain and loss are always in the net concept, right? You don't show the book value, that the book value was 100 and I sold it for 120. So you don't show those two line items separately. Book value of furniture sold, sale proceed of furniture sold. You don't show the two lines separately in the income statement. You straight away show gain on sale of furniture in the income statement. Right? You don't show book value of furniture sold, sale proceed of furniture sold as separate line items. So if I go to the income statement, you're referring to this income statement, right? So if you see here, the line item is loss on sale of fixed assets, straight away 40. They have not shown two lines, one saying book value of furniture of fixed assets sold. Let's say book value of fixed assets sold was 100, and then sale proceed of furniture of fixed assets sold is 140. They have not shown like this, right? They have shown straight away. Oh, sorry, this is loss. So loss means sale proceed is 60. Right? They have not shown this. What they have shown is straight away the loss of 40, which is basically the net amount. That is why we are saying that it is a net concept. If I'm getting your question correctly, right? If you mean something else, then maybe, yeah, you can take down my contact number. I'm in the group, right? My contact number is 98710 97058. I'm in the group already. I'll write it here in the chat box. It's 98710 97058. Oh, sorry, I think I've just written to Rohit. 1 second. I'll write it again. Right, so this is my number. But over the weekends, my weekends are absolutely chock-a-block. Friday, Saturday, Sunday are absolutely chock-a-block. So a good time to connect with me would be Monday or Tuesday, right? My Mondays are a little relaxed because I have a very heavy Friday, Saturday, Sunday. So I keep my Mondays a bit relaxed. So good time to connect with me is Monday, okay? Break for each class is roughly around 9 o'clock, right? So it is already time for a break. So the class is 7 to 11. So around 9 o'clock, we'll have a break. And the evening classes are 6 to 10. So around 8 o'clock, we'll have a break. Okay. But let me quickly take your pending questions before we go, before we take the break. So I hope, so Amandeep, you're going to call me, right? And who else? Sahil, you have a question. Do we need to specify continuing operations at gross of tax in relation to revenue and expense at gross value excluding COGS, and then gain and loss at net value after deducting tax and COGS? Well, see, you don't have to specify. As you can see here in this, they have not specified anything, but that is how it is. I mean, you have to follow that structure, right? You don't have to specifically say that this is gross of tax or this is net of tax. It is already understood, right? Of course, in discontinued operations, you have to specify that it is net of tax here. But for other items, you have not specified that they are gross of tax. It is understood, right? And similarly, like I said here, this gross margin is actually a net number of 650 minus 410. It's actually a net number, but the term that we use is gross margin. Similarly, the sales is actually a gross amount, right? 650 is a gross amount, but because it is net of returns and discounts, we use the word net sales. Right now, it would be very strange to call it net gross sales or gross net sales, right? That is why we don't specify it. Okay, it would be very strange to call it net gross margin or gross net margin, right? So it will be very weird. So that's why we don't specify those things. It is understood. Okay. All right, Sahil. So now let me quickly come to Kapil and Gunjan. Kapil, you said no for something. What was that? Is that a query?
So, sir, you have asked a question that if there is a rule in Indian gap and there is a rule in US gap,
Okay.
so would that be
Yeah.
a wrong answer? So for that, we just
Correct. Correct. So we won't say that it is wrong. It's just that it is different, right? Like I
right.
gave the example of Supreme Court turning down a decision of the High Court, right? And so there are many landmark cases like that in India as well as in the US, where the Supreme Court of the country has completely overturned the decision of the High Court. And so it's not that High Court was wrong, but it's that the Supreme Court's viewpoint was different on the same subject matter, right? So viewpoints can be different, and therefore rules can be different. It's not about whether it is right or wrong, right? Both are right in their own ways. Okay, we are just understanding what these rules are. Okay, and that's why I said in the beginning, don't get into a comparison mode, because that is not going to help you. It is actually going to harm you in the exam. So let's not get into that mode at all, right? So okay, guys, let's take a break now, and we'll resume after the break. Break is normally of 15 to 20 minutes, like in a 4-hour class. I think that much is required. So roughly 15 to 20 minutes. Okay, we'll resume again. So I hope everybody is back on their. So let me say this. I know it's, winter is approaching, especially like in North India. It is getting slightly cold in the mornings. So I know that, and I totally understand that. But please don't take the classes on bed. Please get up, sit on your, like, if you have a study table, workstation, properly sit there in a separate room, close the room, you know focus when the class is going on. Don't do it with some other activity going on the side, or there is a lot of disturbance. Give full respect to this course. It will give respect back to you. If you disrespect it, it will disrespect it back to you. It will disrespect you back. It will throw you off. Absolutely. So I know morning classes are slightly difficult, 7 a.m., especially if you're in North India. But yes, you have to push yourself, force yourself to get up, get out of bed, and sit, properly on the study table. Okay, so do that. Okay, so guys, let's resume. We'll start from income from discontinued operations. So let me give you first a background on this. Is everybody back? Okay, great. So a quick background on this. As I said, discontinued operations has to be shown separately. So if this is your income statement, you have to show discontinued separately. This is your C, this is your D, continuing and discontinued. So it has to be separate. It has to be net of tax. Basically, what is discontinued operations? Okay, let's understand this. if there is a component of an entity that has been disposed of. It has been disposed of during the year, or it has not been disposed of, it has been classified as held for sale. So a component of an entity that has been disposed of or has been classified as held for sale. So how do you classify something as held for sale? If you meet certain criteria. If you meet all these criteria, which we will see in the book, there are 5-6 points. If you meet all those 5-6 points, it is classified as held for sale. So if it is a component that has been classified as held for sale, it will come under discontinued operations. Now, let's take a simple example. Suppose, let's take an Indian example, okay? Because everybody will be able to relate to it. Let's say Maruti. Now, Maruti, it had Maruti 800. It has Maruti 800 was there. It's not there anymore, but I'm just writing it. Maruti 800 was there. Then you have Zen. You have A-Star, right? You have Baleno. You have Swift. You have Swift Desire. Then you have maybe Ertiga. Then you have Ciaz. You have Vitara. All this, okay? Now, if these are separate components, when I say if, I mean there are certain conditions. Again, there are certain conditions. If it meets all these conditions, if Maruti 800 meets all these conditions, then it is a component. If Zen meets all these conditions, then it is a component. If A-Star meets these conditions, then it is a component. So suppose these are all components of the of Maruti, and now Maruti decides to discontinue 800. So it was a component, and Maruti decides to discontinue Maruti 800. So if it meets those 5-6 criterias for held, which is for held for sale, if it meets all those criteria, we will say that Maruti 800 is held for sale. Held for sale. It has not been sold yet, but it is held for sale. That means basically company is actively engaged, actively looking for a buyer. They are hunting for a buyer who wants to buy this. And the moment they get a buyer, they will sell it, right? Like Air India was up for sale. Similarly, let's say if Maruti 800 meets the definition of the component and it meets all these criteria, we will say that Maruti 800 is held for sale. Then we are going to show this in discontinued operations, not in continuing operations. That means now by selling Zen, company earns a revenue. By selling A-Star, by selling Swift, company earns a revenue. It has cost of goods sold, gross margin. All this is for Zen to Vitara. Maruti 800's revenue, cost of goods sold, gross margin is not being shown in income from continuing operations because it is now a discontinued operation. Company is looking for a buyer. It is actively looking for a buyer. It has classified it as held for sale. Is that clear? Now, if Maruti 800 does not meet the definition of a component, Zen, A-Star. Now, 800, Zen, A-Star, they do not meet the definition of a component. Let's say there are 3 criteria for meeting the definition of a component. They don't meet. But as small car segment is a component. Mid, let's say, is a component. Suppose this is mid. and suppose this is big car. Now, small car segment is a component. Maruti 800 is not a component. Small car segment overall is a component. And in this situation, if Maruti Udyog decides to discontinue Maruti 800, it will not be shown under discontinued operations. It will continue to be shown under income from continuing operations because it is not a component. So the word component is very important. If it is a component that has been sold off, disposed of, or is classified as held for sale, then it will come under income from discontinued operations section. Another important word, sometimes in the exam, they will not use the word component, or they will not give you all the criteria of whether this particular line of business meets the definition or not. They will not give you enough information. But just to help you in identifying, they will use the word strategic shift. Strategic shift. Suppose a company is into beverages, ice creams, frozen food. They are also into cosmetics, fast-moving consumer goods, etc. So now they are so the question says that the company wants to make a strategic shift and sell off its cosmetics business. The moment they use the word strategic shift, you know that they are talking about discontinued operations. Okay, so sometimes they will give you the criteria of component, and you will be able to understand through that yes, it's a component that has been sold off, then it's a discontinued operation. Sometimes they will not use the word component, they'll say it's a strategic shift of the company, right? Strategic shift. Then also you know that they are talking about discontinued operations. Okay, is that clear? Now, the question is, okay, once we have identified that Maruti 800 is a discontinued operation, suppose Maruti 800 is a component, so therefore, and they are selling off Maruti 800, so it's a discontinued operation. Now, the next question that comes to mind is that, okay, fine, once I have identified that Maruti 800 is a discontinued operation, what do I have to show in the discontinued operation section? What do I have to show? I have to show only three things. Only three things. There is no fourth item. Three things. There is no fourth item. What are these three things? Income or loss from operations. That means by selling Maruti 800, what was the revenue? What was the cost of, cost of goods sold? Whatever. Basically, the income or loss from the operations. Right? Then you have the impairment loss. And then finally, the gain or loss on the sale of the component. Now, only three things: income or loss from the operations, which means that from operations, which means that you will not actually discontinue the operations. Even if you want to sell Maruti 800, you want to discontinue that segment, right? That does not mean you will stop operations, correct? You will continue to operate, you will continue to manufacture, continue to sell, but you are also looking for a buyer. The moment you get a buyer, let's say now Honda approaches you and says that, okay, we are buying Maruti 800 and we will completely revamp it, but we are buying out this business. Okay, just as an example. So they will sell it off, but they will continue to manufacture and sell, right? Although they are still looking for a buyer. So just like Air India was up for sale, but Air India flights were operating, right? So like that. So income or loss from operations, right? Then the impairment loss and the gain or loss on the actual sale. Now, the next question that comes to mind is that, okay, if I have to show these three things, My year is Jan to December. Okay. So just a quick note here on this. In the US, you can follow any year as your fiscal year. You can follow the calendar year, Jan to December, as your fiscal year. You can follow April to March. You can follow July to June. You can follow October to September. Any. You have, like in India also, we used to have a choice, right? Under Companies Act 1956, there was a choice for companies to decide. They could decide any year as their fiscal year. Companies Act 2013 has made it mandatory to follow April to March. Of course, exceptions are there. But basically what I'm saying is, and I know I myself told you not to go into comparison mode, but this is just a very, non-technical sort of comparison, that in the US, you can follow any year. Mostly entities follow the calendar year, Jan to December, mostly. So whenever I take any example, I am going to stick to the Jan to December time frame. Okay, although the choice is open to the entities. They can opt for any fiscal year. Okay, so now Jan to December. Suppose in April, all the criteria were met of classified as held for sale. Okay, whatever 5-6 criteria are there, all the criteria were met. Board resolution was passed. Company is actively looking for a buyer. All the criteria met. It is classified as held for sale. Now it's a discontinued operation. My question to you is that suppose this Maruti 800, it was making losses. See, ultimately, why would a company discontinue something? Because it's making losses. Normally, you will not discontinue a profit venture. You will discontinue a loss venture. Normally, I'm saying, right? Of course, exceptions can be there. So it was making losses. It made a loss of $3 million in the first 3 months. April to December, it made a loss of $9 million. Overall, it made $12 million loss. On December 31st, when I prepare my financials, okay, or let me show it like this. When I prepare my financials, income statement, continuing, discontinued, in the income or loss from operations, how much I am going to show? Am I going to show 9 here? Am I going to show 12 here? Am I going to show 3 here? What am I going to show here in income or loss from operations in the discontinued operations section? This is my question to you. Am I going to show 3 here and 9 here? Or am I going to show entire 12 in discontinued? How am I going to show it? That's my question to you. So tell me what am I going to show in the income or loss from operations in the discontinued operations section, specifically here. Forget the continuing. In discontinued, what am I going to show? 3, 9 or 12? Yes, your answer. 12, 12, 9, Gaurav 9. Okay, Tanuj 9. Ajay 9. Gunjan 9. Nita 3. Madhur 9. Okay, a lot of people are saying 9. Rohit, Fias, Nikhil, Upinder, Shivangi. And some of you are also saying 12. Okay. 3, there is only one answer. Okay, so let me tell you. The answer to this question is you are going to show 12 over here. You're going to show 12 over here. On December 31st, when you are preparing the financials, it is a discontinued operation. Regardless of when it was classified as held for sale, you are going to show the full year number in discontinued operation. Okay? Regardless of when it was decided. Whether it was decided on 1st January or 31st of December or anywhere in between, doesn't matter. On 31st December, it was a discontinued operation. I mean, it was classified as held for sale. It's a category wise, I'm saying it's a discontinued operation. Of course, operations are continuing, but category is discontinued operations category on 31st December. So you are going to show the full year number under discontinued operations. Is that clear? So that is one very important thing which a lot of students get confused and commit mistakes. Make sure that you don't commit the same mistake. You have to show the full year number in discontinued operations. Now coming to the other item, impairment loss. Impairment loss is, of course, this Maruti 800 as a business, as a line of business, it has certain value. So suppose its value was $2 million. Now, the moment you announced that it is going to be discontinued, right? There will be speculation and its value will fall because market sentiment will be sort of against it, that okay, that means they are selling it off, that means it is incurring losses, this product is not working anymore in the market, nobody will buy it, all sorts of things will happen. So suppose its value comes down to $1.2 million. So now there is a $800,000 loss. Okay, so this is impairment loss. Okay, so this is the second item. So here you showed 12 million as the loss. Here you are showing 0.8 million as the loss, right? 800,000 is 0.8 million. So normally you will have only 2 items out of 3. Normally. So in this particular example, in 2023, April 2023, it was classified as held for sale, but it did not get sold during the year. Okay, they are still looking for a buyer. Now suppose next year, in February, they got the buyer and it got sold. And it got sold for $1 million. So now next year, when you prepare the financials again on December 31st, right? December 31st, when you prepare the financials again, and in these 2 months, suppose it made a loss of $2 million, 1 million, 1 million, 2 million in 2 months. So again, you will have, theoretically speaking, 3 items. First will be income or loss from operations, 2 million. And then there will be the actual gain or loss on the sale. Then you won't have impairment loss again. Similarly, in this year, in the 2023 financials, you will have the income or loss from operations and the impairment loss. You will not have the gain or loss on the sale because it did not get sold. So although theoretically there are 3 items that are shown in discontinued operations, practically there will only be 2 items that will be shown, right? Income or loss from operations and impairment loss, or income or loss from operations and gain loss on actual sale. So in this case, when you calculate, so impairment loss was 0.8, you had already brought it down from 2 million to 1.2 million. So you booked a loss of 800,000 in impairment loss. Next year, when it got sold for 1 million, then you will book a actual loss on actual sale of 200,000. So here you will have 0.2 million, which is 200,000. You will not have this item. Here you will have impairment loss of 0.8 and you will not have this item. Right? So here also you have 2 items and here also you have 2 items. Is that clear? So these are some of the things that you have to keep in mind in discontinued operations. That's it. Now let's go through the module, and I hope some of your questions, in case you have any question, it will get answered through the module. If not, I will take it up at the end. So discontinued operations are reported separately from continuing, that we already know. In the income statement, net of tax, discontinued operation may include a component of an entity, group of components, a business, right? Or a non-profit activity. It can consist of 3 things: impairment loss, gain or loss from actual operations, and gain or loss on disposal. So only 3 items will be there. Okay. All of these amounts are included in discontinued in the period in which they occur. Types of entity to be considered. Results of operations of a component of an entity or group of components or a business not for profit will be reported in discontinued if it has been disposed of or is classified as held for sale. Okay. Conditions that must be present. All related costs shall be recognized when the obligation to others exists, not necessarily in the period of commitment. Disposal of component or group is reported in discontinued if the disposal represents a strategic shift. Very important word. That has or will have major effect on entity's operations. Examples of strategic shift are disposal of a major geographical area, disposal of a major equity method investment. What is equity method investment? We will talk about it later. Disposal of a major line of business. So these are strategic shifts. They want to exit a particular geography. They want to exit out of, let's say, Ukraine, because it's now a war zone. They want to exit a particular line of business. Like I said, they want to exit cosmetics business, or they want to exit frozen food business, because it's a strategic shift, right? Frozen food is causing cancer, and therefore they want to exit out of that. So that's a strategic shift. So like I said in the exam, they may use the word component, or they may use this word strategic shift. You will know that they are talking about discontinued operations. Okay. A business or not profit activity that on acquisition meets the criteria to be classified as held for sale is a discontinued operation. That means on acquisition only, if basically if someone buys it to further sell it, then they are going to show it as discontinued right from the beginning. On acquisition only, if it meets the criteria to be classified as held for sale, meets the criteria to be classified as held for sale, then it is a discontinued operation. Even though you have acquired it, right? You have acquired this business, but it classifies as held for sale on acquisition only. So it is a discontinued operation. Is that clear? This is an illustration. AmServe Inc. is a food service company that delivers frozen food products to food service providers. Its clients include fast food restaurants, high-end steakhouses, home delivery diet food companies, and institutions such as schools and hospitals. So basically, they deliver frozen food. Historically, the fast food restaurants have been the largest segment of AmServe business in terms of revenue and operating profit. However, that division is now forecast to begin to decline in revenue because public is looking for healthier options. AmServe has decided to sell its fast food operation and instead focus on selling to locally operated restaurants offering a healthier fare. Such restaurants will generally show lower revenue per unit but higher operating profit per unit. Because the fast food division is the largest component in terms of revenue and operating profit, the disposal represents a major strategic shift and will be reported as a discontinued operation. Right? So like I said, this word is a hint that it's a discontinued operation, because here by reading this question, you don't know whether it was a component or not a component, right? Like just by reading the question, you will not know whether Maruti 800 is a component or small car segment is a component. But if the question says it's a major strategic shift, then that means you know that they are talking about discontinued operations. Okay. Types of items to be included, I have already told you: results of operations, gain or loss on the disposal, and impairment loss. Only 3 items. Okay, now the question is if there is a subsequent increase in the fair value. So I gave you the example that its value was $2 million, fell to $1.2 million. So we booked an impairment loss of 800,000. Now, subsequently, if its value increases to 1.4, then what do we do about this 200,000? That is the question. So it says even increase in fair value can be shown in discontinued operations as a positive number. Of course, loss is a negative number, but if there's an increase in value next year, then you can show it as a positive number also. So initial and subsequent, a loss is recognized for recording the impairment of the component, initial or subsequent write down to fair value less cost to sell, and subsequent increase, gain is recognized for any subsequent increase. So gain is recognized. So this is an exception to the normal rule. The normal rule is that once you have booked an impairment loss, you cannot restore it back. That's the normal rule. This is an exception that if it goes back up in value, you can record a gain. Gain is recognized for any subsequent increase in fair value. Of course, fair value minus cost to sell. Fair value minus cost to sell is basically in continuation. Fair value minus cost to sell, right? It's one term. Fair value less cost to sell is one term. Okay. So here, let's say in my example, I would say fair value is 1.5, but cost to sell is 100,000. So therefore, fair value less cost to sell is 1.4. Fair value less cost to sell, So minus, this is fair value less cost to sell, minus cost to sell. This is the number we are comparing with the previous fair value less cost to sell number. This is also fair value minus cost to sell, 1.2. This is what we are comparing with this new number, and we are saying whether there is an increase or decrease. If it's a decrease, you book a loss. If it's an increase, you book a gain. Report in the period disposed of or held for sale. I have already mentioned this, right? So in the period it is held for sale, you report. And of course, in the period you dispose it off, you report. Okay, so that means in 2 years, in 2 financial years, it is, being reported. So results of discontinued operations of a component are reported in discontinued operations for the current period and for all the prior periods presented in the period the component is either disposed of or is held for sale. Results of subsequent operations of component classified as held for sale are reported in discontinued in the period in which they occur. So basically what they mean by this is, if you are showing comparative, okay, I'm using the word if you are showing comparative. So 2023 and 2022. Why am I using the word if? Because US GAAP does not make it mandatory to show comparative financials. US GAAP does not make it mandatory. SEC, Securities and Exchange Commission, makes it mandatory. That means for listed companies, it is mandatory to show comparative financials because they are registered with SEC. And it is a SEC requirement to show comparative. For unlisted companies, there is no requirement to show comparative financials. They can show, there is no prohibition. If they want, they can show, but it is not a requirement. They can show only 2023, only one column. It's absolutely fine. Okay. Listed companies have to show 2 columns, 2023 and 2022. Okay. Now coming back to the topic, we are saying that if we are showing comparative, for listed it is mandatory, for unlisted it is optional. So let's say even if it is unlisted, they have decided to show comparative. How are they going to show it? They are going to show in 2022, it was a continuing operation. Maruti 800 was a continuing operation. In 2023 April, it was classified as held for sale. This is 2022. This is 2023. Right? 2022 and 2023. In April 23, it was classified as held for sale. So in the 23 financials, we are going to show it under discontinued operations. Here in discontinued operations. But in 2022, it was normal. It was continuing operation. So are we going to show the numbers of Maruti 800 in 2022 column under continuing and in 2023 under discontinued? Answer is no. No. In 2022, it was continuing. That's fine. Oops, sorry. But in 2023, it is discontinued operation. So when in 2023, you are showing it under discontinued operation, you have to show the comparative here only. Even though in 2022, it was not a discontinued operation. Is that clear? So when you had prepared the 2022 financials, you must have done, you must have shown Maruti 800 here and its corresponding 2021 number over here. You must have done that. But now, when you are preparing the 2023 financials, you are showing Maruti 800 here in the discontinued section. So now what you had shown last year under continuing, you have to bring it down here. The 2022 column numbers. Okay, is that clear? And for all prior periods presented, it will be reported in discontinued operations. Not just for the current period, but for all the prior periods presented. Okay. Next para. Once management decides to dispose the component, assets within this component are no longer depreciated. No longer depreciated or amortized. You will stop depreciating the assets, right? So whatever equipment, machinery, assembly line, whatever you are using for Maruti 800, those assets are not going to be depreciated anymore because now you are showing them at fair value. So you are not going to depreciate them. Component classified as held for sale is measured at lower of its carrying amount or fair value less cost to sell. Right? So you are showing it at actually lower of, whichever is lower, the carrying amount or the fair value less cost to sell. This is one term, okay? Fair value less cost to sell is one term. Because sometimes students get confused that should we compare carrying amount and fair value, and then whichever is less, from that we will deduct cost to sell. Answer is no. Then it will be a wrong calculation. You have to compare carrying amount and fair value less cost to sell. Out of these two, whichever is lower. Is that okay? Presentation and disclosure, of course, it's a separate component of income. It's a completely separate section, right? Discontinued operation is a separate section. And gain or loss recognized on the disposal shall be disclosed either on the face or in the notes. So again, you have a choice. Disclosure on the face or in the notes. I mean, that's the heading only. So I'm not highlighting it. What I'm highlighting is gain or loss recognized on the disposal. That will be disclosed in the face or in the notes. That means basically what they are trying to say is that you can simply have one line in the income statement as income or loss from discontinued operations, net of tax. The details can be in the notes. And the details are those three lines. What comprises of this X amount? Income or loss from operations, impairment loss, gain or loss on actual sale. That is the total X, which has been shown on the face of the income statement only as one line item. Before this line item, it was income from continuing operations. income or loss from continuing operations. Then you had one line discontinued operations, then you have net income. This one line X has three components: income or loss from operations, impairment loss, and gain or loss on actual sale. Is that clear? So you can show these three items on the face also, or you can show just one line item in the income statement and the three items in the disclosure, in the notes. That is what they mean over here when they say on the face or in the notes. Let's try this question. Don't see the answer, please. Even if you have the book in front of you, don't see the answer. Try it on your own. Let's do it together. Trial balance shows trial balance below presents the income statement accounts for year one from all sports companies' trial balance. Golf division of all sports has been losing money on a monthly basis. Golf division's income statement accounts are also presented below. So they have the total trial balance of like the entire company and also the golf division separately. Golf division's income statements are also presented. Board of directors decide on April 30 year one to dispose of the golf division. So here date is not important because regardless of the date, we are going to treat it as a discontinued operation for the full year. Full year number will be shown in discontinued operation, right? So the date is not important. As long as it is year one, that's fine. Of course, we have to ensure that it is within the same year, but then the date does not matter. The carrying value of the golf division on April 30 year one was $4 million. And the fair value less cost to sell is $2.2 million. So right, out of the three items, we have already got one item, the impairment loss, 1.84 minus 2.2 is 1.8. That is the impairment loss. But we have to show it net of tax. So we'll have to show 1.8, but net of tax. Right, so there are three items. One item was impairment loss, which we have already got, right? So this is solved. Now let's look for the first and the third item. After months of negotiations, the division's net assets are sold on June 30, year 2. In year 2, it is sold for $2 million. Now see, in year 1, we will have a discontinued operation section in the income statement. In year 2, also we will have a discontinued operation section in the income statement. In that, we will have gain or loss on actual sale, and that will be 200,000 because we had already reduced it from 4 to 2.2 by booking an impairment loss. And now the actual will then be compared with the 2.2. So 2.2 has been sold for 2 million. That means another $200,000 loss. So we have got this item also, right? So part of the answer is solved. Remember one thing, in the CPA exam, in simulations, there is partial marking. Even if you're not able to complete the full answer, even if you do this one line, you will get partial marking for this one line. Okay. So don't worry. Whatever you know, you should solve it. Okay. Now continuing, the golf division has continuing losses in year 2 of 200,000 per month, and it has been sold on June 30th. That means for 6 months, 200,000 into 6, 1.2 million. We have got another item solved, right? This is 1.2 million. This is 0.2 million, but we have to show it net of tax, right? I'm just writing it here as 1.2 and 2, but we have to show it as net of tax. Golf division has continuing losses, done. Income tax rate is 40%. So this will be shown into 0.6 because we have to show it net of tax into 0.6. Is that clear? Assume that all sports company continuing operation is 4.87 million in year 1 and 5.2 million in year 2. So this is continuing operations. If we have to show the full income statement, then we will have to show the continuing also, and then the net income. Similarly here, continuing, discontinued, and net income. Okay, so continuing is 4.875. And here it is 5.2. All right, now let's look at the trial balance. Sales revenue of the golf division 2.5. Cost of goods sold, freight out, commission, advertising, insurance, salary, depreciation. So basically just add all this and deduct it, we will get the loss. right? So let's do it. $4.9 million. So 4.9 and difference between this and 2.5, 2.4 million loss, right? So that means we have got this item also now. $2.4 million loss. Of course, we have to show it net of tax, right? So, and this one was 1.8 million. We have to show it net of tax. So year one is solved. We have got both the items. This item is not applicable in year one, right? So we have got two items. Year two also we have got two items. Impairment loss is not applicable in year two, right? So this we have got, this we have. So we have solved the question, right? Of course, net of tax, you have to show 2.4 net of tax would be 1440. 1440 and 1.8 million net of tax would be 1.08. That means 1,080,000. So the total would be 2,520,000, and this is 4,875,000. So net income would be 7,395,000. Year one, year two, 720,000 and 120,000. Wait, here it was, this was also a loss and this was also a loss, right? Wait, and the 4,875 was actually a profit. Okay, so it is not 7,395. It is not 7,395. Year one, 4,875 is a profit and 2,520 is a loss. This is actually 2,355. This is a loss. Okay. So the net income is 2,355,000. Year two, 5.2 million is a profit, and this is a loss. 20,000 is a loss, and actual sale is also a loss. 840,000 loss. So now the total number would be 4,360,000. So this is our final answer. Year one net income 2,355. Year two net income 4,360. I hope it's clear to everyone. I know I've written it very small, but I hope it is clear. Let's see. 2,355, 4,360. Right? So continuing operations was given in the question. This we have solved, 1440 and 1080. Similarly, 5.2 was given in the question. And this we have solved. Okay, so before I go to the next topic, your questions. Before I take your questions, just see The discontinued operation section has only two items: loss from operations and loss from impairment. And obviously the loss from operation is for the full year, right? Because this trial balance covers the entire year. It is year one trial balance. So entire year's revenue, entire year's expenses are given over here for the golf division, even though the decision was taken on April 30th. We are taking the full year number. Okay. So full year number has to be taken. Just in case, you had any doubt in your mind, I'm showing you that full year number has to be taken. So you have only two items. Okay, number one, number two. Similarly, in year two, you have only two items. Loss from operations and loss from the sale. Okay, now your questions. In case of common cost between continuing and discontinued, how will those be bifurcated? They will be bifurcated based on your allocation principles, what you follow in costing, or for management reporting purposes, right? You allocate your, let's say, headquarter cost, right? Cost of HQ is allocated to all the departments similarly. So there has to be some basis on which that allocation is done. That same basis will be used. Okay, MVK. Then Shivangi, you're saying 4.2 की last line समझ नहीं. 4.2. A business or not profit activity that on acquisition meets the criteria to be classified as held for sale. That means company A wants to sell off, suppose Maruti 800, right? A is Maruti Udyog. So Maruti Udyog wants to sell off Maruti 800. Company B wants to buy it, but not for actually, not for manufacturing and not for getting into this business, but they are buying it to further sell it off. So on acquisition itself, they have decided, they have passed a board resolution that they will want to sell it off. They meet all the criteria of classified as held for sale. So when you prepare B's financial statements, in 2022 only they bought it, and in 2022 only they met the criteria of classified as held for sale. So when they prepare, company B I'm talking about, when they prepare financials, they are going to show this Maruti 800 under discontinued operations. So even they are going to show it under discontinued, because on acquisition itself, purchased it, they acquired it in 2022. On acquisition only, they met the criteria to be classified as held for sale. That means basically, in simple words, they purchased it to sell it off further. They don't want to get into this business. They are just the intermediaries. They have purchased it to sell it off further. Okay, Shivangi. Ajita, in case operations held for sale are not sold for more than 1 year, or the decision is retracted, then how that is treated? Okay. First of all, the criteria, it's not mentioned over here, but one of the criteria is that the company has gone so far ahead in this process that they cannot now take a step back. They cannot go back on their decision. Okay. So basically, practically what that means is Of course, board resolution has been passed. They have announced this discontinuation, discontinuation. They are actively looking for a buyer. Actively looking for a buyer means the word is they are actively looking for a buyer, right? And they have also committed funds. For example, they have engaged engaged an agency to look for a buyer, because these kind of deals happen through intermediaries, and these intermediaries are not individuals, these are huge companies, right? So some consulting firm would be engaged, some big bank would be engaged in this process, right? So suppose they have engaged Citibank, they have engaged A.T. Kearney or Accenture, or they have engaged a big four, KPMG, Deloitte, for this transaction to go through. So they are committed, they are fully committed in this, they want to get rid of it, and it's a loss-making operation, right? There is no question of coming back. So I hope that answers your question. Yes, time, it may take more than 12 months, it may take less than 12 months, that's fine. As long as the commitment is there, the board resolution is there, the process is in place to sell it off, everything is going as per plan. Yes, locating a buyer may take, instead of 12 months, it may take 15 months, it may take 18 months, that's fine. It is a discontinued operation. But coming back on your decision is not something that is envisaged in this scenario. Make sense? While acquisition, the decision may change to keep. Well, see, I mean, practically, if you see who is buying it, are they into this business, right? If a car manufacturing company is buying it, then they may want to continue, they may want to operate it, they may want to actually be involved in it. But let's say if an intermediary is buying it, then obviously they are never going to get into a car manufacturing business. Their business is not into manufacturing. Their business is just buying and selling businesses. Their operations is buying and selling businesses, right? So I hope you understand what I'm saying. So depending on who the buyer is, you will know whether it is even possible, right? They will know that they never want to get into this business. So they will be very clear in their mind that we are buying it to sell it off further. Okay. Does that answer your question, Pratima? If not, I will come back to it. Let me just quickly take other queries. So Ajay, your question was answered. Next is Sahil. Okay, fair value, subsequent increase in fair value. So Sahil, fair value can slightly go up also in the future. So right now in my example, I said that its value is $2.2 million, gone down to 1.2. From 2, it has come down to 1.2. Next year, it may go up to 1.3. It may just increase a little bit, right? It may go up to 1.3. In that case, we will record a gain of $100,000 in the next year's financials. That is called subsequent increase in fair value, right? Akansha, where we got the 1.2? No. So that is just an assumed number. From 2 million, it went down to 1.2 million. Are you talking about my example or this book example? 1 second. You're talking about the book example, right? So $1.2 is because they are making a loss of 200,000 per month. They are making a loss of 200,000 per month. And they have sold the business on June 30th, year 2. That means Jan to June, 6 months. 200,000 per month. That means 200,000 into 6, $1.2 million. See, if the question is silent, you will always assume a calendar year. Fiscal year is the calendar year. That means Jan to December is the calendar year. So if Jan to December is fiscal year. So if Jan to December is their fiscal year and they have sold it in June, that means Jan to June is what we will report in year 2. Okay. Then Shivangi got it. Great. Pratima, while acquisition, the decision may change to keep. So I think I answered that question, right? The buyer company will know what is their intention, whether they want to keep it or they want to sell it. And based on that intention, the financials will be prepared. Of course, if their intention later changes, if they had acquired to sell it, but then they decide to actually get involved in that operation, then of course it will become their continuing operations. Right. So the whole idea is that if you want to discontinue something, you have to show it separately. You can't merge it with your normal operations. The whole idea is about transparency. Look at the intent of this rule. The intent is that shareholders must know that they are discontinuing with this operation. This loss will not happen in the future. Right now, this Maruti 800 is making losses. Company is looking for a buyer. They are trying to sell it off. This loss will not happen in the future. So again, predictive value, right? That's why you are separating the continuing operations from the discontinued. And that, of course, depends on the intention of the management. If the management intends to operate and continue that operation, then it is continuing operations. If the management intends to sell it off and it meets the criteria, then it is a discontinued operation, right? Of course, we cannot question the intention of the management. That is something we have to assume that, okay, the intention of management is this, then the accounting treatment will be this. So if you're saying that the intention only changes, when they purchased a component, they had the intention to sell it off. But by the time the December 31 came, they have not sold it off, and they have started to actually operate that business, and they don't meet the criteria for as classified as held for sale anymore, because they are not actively looking for a buyer, right? Then one of the criteria is that the operation must be able to be sold. It must be sold in the as is condition. That means you don't have to make any changes, any improvements to it for it to be able to be sold, right? It can be sold in the as is condition. Whatever condition it is in, it will be sold in that condition, right? So if the management has started making certain improvements because they want to continue in that, they are doing their own market surveys to see why this product is not getting sold, why the demand has decreased, what needs to be changed, what features have to be added, or what upgrades have to be done, etc. If they are engaging, if they are focusing their energies on reviving it, then obviously it's not a discontinued operation. That means automatically they are not meeting the conditions for classified as held for sale. In classified as held for sale, you just continue the operation without making any changes to it, without trying to revive it. You are actually trying to sell it off. Okay. So obviously the energies will be very different. The focus will be very different, right? Management's intention will be very different. All that will come into play. Is that clear? Okay. Please explain example 3 again. Example 3. The whole example again. Okay. So I'll do it this time. I'll do it on the white sheet, because there is no space left over here. So see, we are talking about 2 years. Year 1, year 2. In year 1, when we prepare the financials, there is continuing operations, there is discontinued operations. Continuing operation figure is already given to us, 4875,000. Year 2 continuing operation, also figure given to us 5.2 million, right? If I'm not mistaken. Now, discontinued operation year 1, you will have only 2 items, income or loss from operations and impairment loss. And in year 2, you will have 2 items, income or loss from operations and the gain or loss on the actual sale. So in the question, they have given us the trial balance. From the trial balance, we saw that revenues are 2.5 million. 2.5 million and expenses are 4.9 million. Therefore, there was a loss of 2.4 million. So we will write that here, 2.4 million, but net of tax means 1 minus tax rate. Tax rate is 40%. So 1 minus 0.4. That means 1 minus 0.4 means 0.6. So 2.4 into 0.6, that came to 1440. Impairment loss was the valuation of this business was 4 million. I mean, the carrying amount was 4 million, but the fair value less cost to sell was 2.2 million. Right? All this is given in the question. Okay. 2.2 million. So then there is a loss of 1.8 million on that impairment loss. So we will write impairment loss 1.8 million into again 1 minus tax rate. That came to 1080. These two are losses. So now you have total discontinued operation loss. $2,520. And you have a profit of 4,875 in the continuing operations. So your total net income, this is a positive number, this is a negative number, right? So the net amount is 2,355. This is your year 1. Year 2, there is a $200,000 loss every month. So 6 months, 1.2 million into 1 minus tax rate. And the sale happened for $2 million. So we had already brought it down to 2.2 and now it got sold for 2 million, right? That means $200,000 loss into 1 minus tax rate because we have to show net of tax. So this is coming to 720,000 and this is coming to 120,000. Both of these are losses. So total loss of 840,000. And so the net income is $4,360. This is your answer. Neela, is that clear? So Pratima, you're saying, just wanted to check if we can move from discontinued to continue. I would say 99% cases no, because you have gone so far ahead in the process that you cannot come back. And if you are a buyer, then obviously, you would, as a buyer, you would know whether you want to actually get into the business or, that your construct would be such, right? Now, a company that is not into car manufacturing, if it is buying a Maruti 800, why is it buying? To sell it off. They're not going to get into a car manufacturing business, that too with a loss-making operation. Even if they had to get into a car manufacturing business, they would probably start their own manufacturing. They would not buy a loss-making entity and get into a car manufacturing business with a loss-making operation, right? So, so practically you will know, this doubt will not arise in a practical situation, I hope. Theoretically, yes, theoretically everything is possible, but even theoretically, I would say 99% you cannot come back to a continuing operation from a discontinued, because one of the criteria for classified as held for sale is that you have gone so far ahead in the process that you cannot come back. You have committed yourself to that process of sale. Okay. Yasmin, request if you can read out the question before giving the answer. So I did that. I mean, first time I read the whole question line by line only. In case you had some network issue or something, then maybe you can see the recording later. But I did read the question. I read the question over here, line by line. I highlighted also. I read every figure, highlighted all the figures. Maybe I went a bit fast. Maybe you can say that I should slow down. That I agree. But I did read the question. Okay. What else? Where we got the 6 lakhs in the second year in the book example. 6 lakhs. In the second year, there is no 6 lakhs. There's no 6 lakh figure in the second year. There is 1.2 million and 200,000. And then this is net of tax. So which 6 lakh are you talking about? Ignore. Okay. Okay, fine. Continuing operation ka tax. Shivangi, continuing operation, if you read the language of the question, it says all sports income from continuing operations. Read this line. Income from continuing operations is this much and this much. What is income from continuing operations? It is after tax. It is after tax. Look at this example. Income from continuing operations is after income tax expense. That means it is already after tax. Is that clear? Amandeep, can you please explain subsequent increase in fair value with an example? I already did that, Amandeep. Do you want me to repeat that? I said 2 million gone down to 1.2. 2 million gone down to 1.2. So we booked an impairment loss of 800,000. Subsequent year, it went up to 1.3. So now we can recognize a gain of 100,000. This is subsequent increase. This is, let's say, in 2022, and this is 2023. In 1 year, it went down. In the next year, it actually went up by 100,000. Okay. Akshita, if we realize profit in subsequent year on sale more than the impairment loss, how do we treat it? No, see, the point is, when you prepared the 2022 financials in the discontinued operations, you showed impairment loss of 800,000. And now you are saying that the actual sale happened for more than 2 million. Are you saying that? That next year, there is a gain on sale of more than 800,000. Is that what you're saying? That is unlikely, very, very unlikely, highly, highly unlikely. Gain on sale, something whose value had dropped and it is a loss. Remember, it's a loss-making operation. Normally, discontinued operations are loss-making entities. So in the books, it is at 2 million, but its actual value in the market, fair value, would be much less than this. Yes, within this, within this, it can go a little bit up and down. 1.2 can become 1.3, it can go down to 1.1, it can go up to 1.4. Within this, but it is highly unlikely, almost impossible that it will go above 2 million. You know what I mean? The company is showing it at 2 million, but its fair value is much less because it's a loss-making entity. So the question of it going above 2 million is almost impossible. Okay, Akshita, does it make sense? Yes? Okay. Then Vivek Shankaran, sir, the book says it should not be more than the cumulative loss for subsequent increase in fair value. This is exactly what, I just explained to Akshita. It should not be more than the cumulative loss for subsequent increase. So what that means is, can you just quickly tell me the para number? In the meantime, Amandeep, in the next year, all the 3 points will come regarding discontinued. No, in the next year, typically, like we saw in this question also, in the next year, you will have the income loss from operations and you will have the actual gain or loss on the sale. Right? You will most likely not have another impairment loss again. Okay, so typically you will have only 2 items out of 3 in a particular year. 4.3.1 bracket. Okay. See, theoretically anything can happen, but I'm saying practically you will have 2 items in a particular year. 4.3.1. Yes, not in excess of the previously recognized cumulative loss. This is exactly what Akshita's point was, that if we have booked an impairment loss of 800,000 in year 1, impairment loss of 800,000 in year 1, can we show a gain of, or let's say, can we recognize a gain of more than 800,000 in year 2? And the answer is no. First of all, practically it won't happen. And theoretically, even if it happens, you cannot do it. You cannot do it in excess of the previously recognized cumulative loss. So if you have recognized the loss of 800, you cannot recognize a gain of more than 800. Maximum gain you can recognize is 800, maximum, not more than that. Okay. So all doubts cleared? Let's proceed. Okay, foreign currency transactions. Foreign currency transaction, simple topic. Transaction is simple topic. Foreign currency translation is a tricky topic. But foreign currency transaction is a very simple topic. That means, let's say if I take the example of imports, okay, import is a foreign currency transaction, export is a foreign currency transaction, right? Basically. So if you imported something, you would do either purchase, right? So in the US, they write like this. In like we write purchase account debit, they write debit purchase credit, debit something, credit something, right? So like this. So debit purchase credit, let's say AP. And suppose let's take this example of $1 is equal to 80 rupees. And we are importing something from the US, right? So we will do purchase. I'm taking the example of an Indian company importing something from a US company, right? So the Indian company obviously is preparing its books in Indian rupees. It has imported something from the US. It has to pay in dollars. So when it books the purchase, it will show 80, debit purchase, credit AP 80. So this is the exchange rate on the date of the transaction. Now on December 31st, when you are closing the books, suppose the exchange rate changes to 82. So what will you do? You will debit a foreign currency transaction loss of 2 and you will credit AP with 2 because you will have to pay the party accordingly. You will have to pay the party $1 only, but now you will have to spend 82 rupees to buy that dollar, right? So this is what it is. Now, finally, on the date of payment, suppose the exchange rate is $1 equal to 83. Then finally, you will do credit cash. So you will do debit AP. Now remember, AP is standing in your books at 80 plus 2, 82. So you will debit AP with 82 only because it is credited with 82 only. But you will credit cash 83 because that's the exchange rate as on the date of payment. So you will again debit another foreign currency transaction loss of 1. On the other hand, if the rate was different, let's take another example. Instead of 80 $1.80, it became $1.78. So now you will debit AP and bring it down to 78. You will debit AP by 2 so that it now comes to 78 and you will credit the foreign currency transaction gain. And on the payment date, suppose, we can use any permutation combination. Payment date, suppose it has become 79. So if it has become 79, then you have to pay 79. Your AP is standing in the books at 78. So there is a $1 foreign currency transaction loss, right? So these are some very basic entries. I hope all of you know it from your school, college, BCom days. There's nothing new as such. There's no US GAAP angle to this as such. It's just basic simple entries. Okay. Foreign currency transaction gain losses occur when a company buys from or sells to a foreign company with whom it has no ownership interest. Because if it has ownership interest, then it will become an intercompany transaction. And then, it's a different ball game. But here we are talking about two unrelated parties who are transacting between them and agrees to pay or accept payment in a foreign currency. Transactions between the subsidiary and parent of a permanent financing nature are not considered foreign currency transactions. So that's why I said with no ownership interest. Transaction between parent and subsidiary will not be considered as a foreign currency transaction. That is dealt with separately, in a separate manner, which we will do in. Now I think it has been removed to bar. It is not a part of FAR anymore, right? So FAR has actually, like I said, simpler topics now. The complicated topics have gone to bar. Okay. Foreign currency terminology, exchange rate, is the price of one unit of currency expressed in the unit of another currency. That means in my example, which I just took, I said $1 is equal to 80 rupees. So this is called exchange rate. Now, there are two ways to express it. Direct method, indirect method. Direct method is domestic price of 1 unit of another currency. So for us Indians, dollar is another currency. Our currency is INR. Dollar is another currency. That means when we say 1 unit of another currency, 1 unit of dollar, which is another currency for us, this is called the direct method. But when we say 1 unit of the domestic currency, if we say 1 rupee is how much dollar, right? That will be called indirect method. Because for us, Indian rupee is the domestic currency. Right? So 1 rupee is how much dollar? $0.0125. Right? So this is the direct method. This is the indirect method. Current exchange rate is the exchange rate at the current date, right? Which is also called the spot rate. Exchange rate at the current date is called the current exchange rate, also known as the spot rate. Denominated or fixed in a currency used to negotiate and settle the transaction either in US dollar or a foreign currency. That means basically in this example, the import is denominated in foreign currency. That means we have to pay in dollars, right? When we are importing something from the US, we have to pay in dollars. That means it is denominated in US dollar. This contract is a US dollar contract. It is fixed in that currency. Okay, so you could have a contract in US dollar. You could also have a contract in some other currency. Right? You could have a contract in INR. You could have a contract in euro or whatever. But yeah, the point is that it is fixed. The currency is fixed. Changes in exchange rate will result in a gain or loss, like we saw through those journal entries. And that gain or loss, where will it go? To the income statement. Right? Not settled at the balance sheet date. Again, if it is not settled at the balance sheet date, then whatever is the exchange rate on the balance sheet date, it will be, it's called true up or true down. Basically, we'll do a catch up, like I showed in the journal entries. Right? We did a catch up of 2 rupees or 1 rupee or whatever it was, depending on the situation. So that will also go to the that's called unrealized gain or loss. That will also go to the income statement. And the asset and liability value will also keep changing accordingly. Right? Like in my example, the AP, in the first example from 80, it became 82. In the second example from 80, it became 78. So the asset or liability obviously will also undergo a change. Okay, let's try this example. Don't look at the answer, please. Yeah. On December 1, year 1, remember in the US, they write the month first, right? So sometimes in interest calculations and all that, there is a chance of committing an error. So make sure that you read it like this, the MMDDYY. Okay, so this is not 12th January, this is December 1st. Okay, so on December 1, year 1, Olento company purchased goods on credit for 100,000 pesos. Peso is the Mexican currency. I mean, you don't need to know which country's currency it is. That's not important. I'm just telling you that it's a Mexican currency in case you don't know. So basically it purchased goods on credit for 100,000 of the foreign currency. Now Olento company paid for the goods on February 1st, year 2. That means they purchased it on December 1, year 1, and they paid for it on February 1st, year 2. Now obviously in between these two dates there is the balance sheet date. So we have to close the books also on December 31, year 1. That's why they have given 3 rates. Now 100,000 pesos exchange rate is $0.1. That means we are talking about $10,000, right? So 100,000 peso is equal to $10,000. Correct? That means we will on this date we will do the entry debit purchase, credit AP, $10,000 in our books. Our means the American company's books, Olento company's books. We will pass this entry debit purchase credit AP 10,000. This is the date of the transaction. Then on December 31, we will have to close the books. So on December 31, the rate has come down to 0.08. That means now 100,000 peso is equal to $8,000. So if it is $8,000, we will debit AP with 2,000. That means there is a foreign currency transaction gain of 2,000. Now on February 1st, the rate has gone little up to 9. That means 100,000 peso is now $9,000. So that means we will have to pay $9,000 to our party, to the AP, credit cash 9. But we can debit AP only with the amount that we have credited them with. So we have credited them with 10 minus 2, 8. So we can debit them with only 8. So therefore, the balance is foreign currency transaction loss of 1. So there are 3 entries, one on the date of transaction, second on the balance sheet date, third on the date of payment. Is that clear to everyone? Now let's compare the answer. Debit purchase credit AP 10,000. Debit AP credit foreign currency transaction gain 2,000. Finally, debit AP 8. Debit foreign currency transaction loss 1. Credit cash 9. Excuse me. Is that clear? So simple stuff. There is no US GAAP over here. This is simple journal entries. Only US GAAP rule here is that you have to close the books on December 31. So you have to change the value of the asset or liability accordingly. And you have to book a transaction gain or loss accordingly. And that this transaction gain or loss will go to the income statement, not to OCI. It will go to income statement. That's the US GAAP part of it. Otherwise, journal entries are very simple. Then comes the next topic, comprehensive income, and it is already 11. So maybe we can continue with this tomorrow. Let me quickly take your questions. Transaction between parent and subsidiary not considered as foreign currency. So don't worry about it. This will be covered in consolidation. Any transaction between parent and subsidiary is an intercompany transaction, and it is actually eliminated. Intercompany transactions are actually eliminated when we do consolidation. Okay, so don't worry about it right now. And second, Ajay, asset and liability changes also goes to income statement. I mean, the other leg of it goes to the income statement. Of course, the asset will go to the balance sheet, the liability will go to balance sheet, but the other leg of that journal entry will go to the income statement. That means in this example, when AP reduced from 10 to 8, we debited AP by 2,000. So now when we make the balance sheet and we show AP, we will show AP at 8,000. The other leg of this transaction is the gain, which will go to the income statement. So in the income statement, we will show foreign currency transaction gain of 2000. In the balance sheet, we will show AP at 8000. Is that clear? Ajay, yeah. Ankur, tomorrow we'll do revenue recognition? Maybe not, because today, today it was a slightly slower class because it was the first class, right? So I was also going a bit slow. Maybe from tomorrow we can increase the pace a little bit, but I don't think we'll be covering revenue recognition in tomorrow's class. But I'm not sure. Maybe if we are able to, let me see quickly. If we are able to complete chapter 1 tomorrow, then we have a chance. 1 second, let me see. Yeah, so revenue recognition could be, it is possible, but I can't comment right now because it depends on how many queries we have in the other topics. If we have less queries, then maybe we can finish it off and go to revenue recognition. If we have lots of queries, then it will take time. So Ankur, I cannot tell you for sure. Vivek, do we have consolidation? So we have one module on consolidation in FAR, but the tricky part of consolidation is in bar. Okay, Vivek. Kapil, for one entry, there is narration mentioned. Do we need to mention for each entry? Yes, yes. We need to mention narration if it is, see, in a MCQ, there is no concept, there's no narration. But in a task-based simulation, if they give you journal entries, normally they don't ask for narration. But if it specifically asks for narration, then you have to give narration for every entry. But 99% cases I have seen, they don't ask for narration. Right? You just have to give the entry. And version of Becker book applicable for FAR new syllabus is 1.0. Okay. So all queries sorted out. Let's close the class here. I'll see you tomorrow evening. Sundays is evening class, 6 p.m. Okay. So thank you guys. Have a great day ahead, and I'll see you tomorrow evening.